most likely we see a slowdown in payroll growth. Over the next couple months, we see this gradual slowdown.
The data is going to weaken. The growth rate is going to fall. The unemployment rate is going to rise.
If you get a 0.2 rise in the unemployment rate, the market is going to respond quite negatively to that.
Labor demand has cooled significantly, but we're not seeing mass firing.
If we see a sub 100,000 job and certainly a negative jobs number, that would start to create the narrative of weak, hard data that would allow the Fed to cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning, good morning. For our audience worldwide, Bloomberg Surveillance starts right now. Coming into Thursday, they have the votes.
We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We are going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. Look forward to moving it forward.
House Republicans heading towards a final vote on the one big, beautiful bill. As investors gear up for a very rare Thursday jobs report later this morning, President Trump is doubling down on his criticism of Fed Chair Jay Powell. Is Operation Get to the Beach slightly delayed?
And that seems to be the story of the year, where every time we think that maybe we're getting some certainty, it seems like, oh, just hold on a second, there's just one more wrinkle. That said, heading into the second half of this year, one thing that I've really noticed in all of the analyst notes and frankly in the policy as we see solidify in Washington, D.C., there is a modicum more of certainty, a sense of we understand what the range of extremes is, and we have a greater sense of exactly what could get through the House, what could get through the Senate, and what Hakeem Jeffries is holding up for a couple seconds before it gets through.
Few more hours?
Yeah. I don't know. I think the
hours.
magic minute is more like, the magic hour. So we'll see.
Then once you get past taxes, it's on to trade on July 9th. One of my favorite stories of the last 24 hours. Vietnam, you get a 20% tariff, and Nike rallies. Nike rallies because 20% is not 46%, and apparently that is good news.
Yeah, Nike, Lululemon, we saw on holdings because they were worried that they might get something like a 45% or 46% rate, which was the initial one that was placed on Vietnam. There is this feeling that given how much lower costs are in places like Vietnam, something like a 20% tariff rate could be absorbed. There also is a feeling that the punitive aspect of Chinese exports that go through Vietnam, that's going to be 40%, but it's not going to necessarily be a deal breaker where suddenly trade between Vietnam and the U.S. are cut off. So is this the paradigm where you just want certainty and then we can rally, even though it means the highest tariffs going back to the 1930s?
We'd love some clarity on something right now. Later this morning at 8:30 Eastern Time, you get a jobs report. I'm not sure you'll get any clarity whatsoever. Whatever this number looks like, there'll be a massive debate on Wall Street. Is it a reflection of draining immigration out of the labor market, or does it speak to a weakening in jobs? This is what we're expecting. The median estimate in our survey, 106K. The high is 160, the low is 70. The president's already saying too late, should resign immediately. And I have to say, when he put that out on social media yesterday, a lot of people asked the same thing. Did the president just see the jobs report? And that's unnerved some people going into this.
Yeah, which raises this issue of how they're going to message it, which you've been asking about for quite a while. You have to wonder that. He's also been calling him too late for a while, and this was tied to some of the renovations of the Federal Reserve, so hard to really parse through this. That said, what is weak, and we've been talking about this extensively, a low headline number doesn't necessarily mean a weak market for jobs. It might just mean that there is a low hiring, low firing dynamic. That's the reason why 4.26% unemployment rate going up to 4.28% will be deeply parsed. And if it goes up to 4.36%, all of a sudden the world will collapse because you've got a 4.4% unemployment rate rounded up.
Stephanie Roth's going to join us later from Wolfe Research, right? And I remember a few months ago, she said you could see jobs sub 100K and you could still see unemployment held steady, and it maybe even falls. That's a dynamic that I don't think we're prepared for, but it's a lot of things that are on the minds of economists right now on Wall Street.
Yeah, she also thinks that the headline number is going to be something like 130 jobs added, but then it's going to get revised down to 100,000 jobs added in the post-payrolls revisions, which just highlights the number generator that we're talking about here and how much people take a look at this stuff and say, okay, this is an approximation of now, it will change.
Jobs report at 8:30, 8:31, the rush to the beach begins. here in New York City ahead of the long weekend. Equity futures on the S&P just about unchanged on the S&P 500. Coming up this hour, Max Kettner of HSBC with stocks back at record highs. Andy Laperriere of Piper Sandler as the House nears a final vote on the tax bill, and Sarah House of Wells Fargo looking ahead to the payrolls report. We begin this hour with our top story. President Trump's tax and spending bill heading for a final vote in the House. Bloomberg's Tyler Kendall joins us now from Washington for more. Tyler, we're getting closer.
Yeah. Hey, John. Good morning. We're definitely getting closer. It took all day yesterday and an overnight session, but it appears Republicans have paved the way to pass President Trump's cornerstone of his legislative agenda. Now, to sort of get our bearings on what's happening right now, we see House Democratic leader Hakeem Jeffries. He's speaking on the floor. He's afforded something known as the magic minute, which essentially means he can talk for however long he wants. He started at 4:54 a.m. Eastern. We're not expecting him to go on that much longer because once he stops, that's when we are expecting that vote on final passage. And we're actually thinking that that vote's going to get wrapped up pretty quickly because it appears that these holdout Republicans were able to reach some sort of deal in order to get them over the finish line. And that's one of the biggest questions here this morning, because I have to say I was on Capitol Hill for a long time yesterday, and I spoke to many of these holdouts, including the chair of the House Freedom Caucus, Andy Harris, also Chip Roy, a Republican from Texas, both of whom were threatening to bring the Senate back into session. But at the end of the day, that's not what happened. The House is accepting that Senate's bill. So that means, did they get some sort of concessions from the White House when it comes to executive orders or legislative commitments down the road? Or was President Trump's pressure enough to flip them alone without any sort of tangible concessions? Because, John, flip they did, including one member that we have been watching closely, Thomas Massie, a Republican from Kentucky. We weren't expecting him to vote for this. He voted no on the package back in May and faced a primary challenge from President Trump because of it. He voted in favor of the rule. That was a pretty significant development, and we are expecting that he could vote for final passage here, although anything could really happen.
Tyler Kendall with the latest. Tyler's going to be tracking the story for us throughout this morning. Tyler, thank you. Can we stand those pictures just for a beat? Trying to figure out if she was sleeping or on the phone.
Oh, she was 100% sleeping.
You think she was sleeping?
Absolutely. Look at her eyes. I mean, honestly, I don't blame any of these people. They've been up all night. They've been up. They came from their beach to come back to vote on this. They don't exactly look pleased. Check it out.
What did you do yesterday? Like the world's smallest violin for these guys? Yeah. Here's the view on Wall Street this morning. Max Kettner of HSBC writing, with widespread pessimism and markets facing a massive wall of worries in the coming weeks, there's more than enough to keep investors cautious. Max joins us now for more. Max, you've been constructive, bullish for quite a while now. Do you think this market is going to look through any potential weakness at 8:30 Eastern Time?
Yeah, I think it depends what kind of weakness we get. I think if we track sort of like roundabout within 50K downwards of price, I think that actually would be taken probably with a sigh of relief after the negative ADP numbers yesterday. So if we had a sort of 60, 70, 80K number, I do think that actually is probably a pretty good Goldilocks kind of outcome, where, you know, you get yields down, but also risk assets across the board can rally, perhaps even with a bit of a weaker dollar, because people would probably take that as further evidence of the labor market getting a bit weaker, even though I'm not fully on board with that, because, again, when we look at a lot of the data, even yesterday, right, a lot of the focus was on that weaker ADP data. But let's face it, when we look, for example, at the job cuts number yesterday, which, frankly, everyone sort of ignored, but then, you know, you look at that, that's been going down to pretty much the lows from late last year, with pretty much almost all the sectors recording less and fewer job cuts. And still, people are squarely only focused on that negative kind of connotation. And that really tells you also where positioning is. So what is remarkable still to us, I keep banging on about it pretty much every week when I'm on with you guys. It's like, oh yeah, positioning is still low, people are still bearish, and there's still no sell signal, and it just keeps continuing. We're still at an all-time high, we're printing new all-time highs in stocks, spreads are grinding tighter, and you're still nowhere near. You're a gazillion miles away from a sell signal. And that's what keeps this market in this kind of Goldilocks state.
Max, yesterday was a really interesting case study, I think, for the trade story. A week away, the president comes out and declares some kind of an agreement, a trade deal with Vietnam. And companies exposed to Vietnam, the likes of Nike, rally on it. 20% tariffs and Nike rallies, because this market was still anchored to the risk that maybe it's going to be the 46 he announced on April 2nd. Is there a read-through there from yesterday, maybe into July 9th?
To me, there is, because not only in terms of the amount of tariffs, but also in terms of perhaps any kind of potential deals until then, or maybe even perhaps after the 9th of July, Because, of course, I think the market, and particularly risk assets, will take it increasingly as a positive once you get another couple of trade deals over the line. And, of course, you could say, well, but the average tariff rate, isn't it going to be higher, and obviously much higher than compared to what we had a year ago or even 6 months ago? Fine. But what we do have is clarity. We have less uncertainty. And let's face it, when we look, for example, at all these sort of popular economic policy, political uncertainty indices, trade policy uncertainty indices, all of those have been in uncharted territory, particularly in April. They've been even higher than during the depths of the COVID lockdown. And of course, any kind of marginal decline in uncertainty, any kind of marginal increase of clarity, in fact, should be helping investment. It should be marginally helping perhaps consumers, helping companies to have a bit more clarity and to move on from that in the second half of the year.
Which raises this question, Max, what's being priced in? I mean, essentially, anytime we get clarity, people say, oh, that's priced in. But the clarity is different every single day, whether it's the clarity of what kind of rate we're talking about with tariffs or the clarity of how big the U.S. deficit is going to be. All of these worries that we had earlier in the year that are now being shrugged off as priced in. How do you determine between rational versus numb?
I think it is entirely rational because when we look, for example, at what is expected for the Q2 reporting season about to start next week, we started the Q2 expectations, bottom-up expectations from consensus about 3 months ago with around about 10%. We're almost only at 3.5% now, right? So consensus is saying earnings sequentially, quarter on quarter, will be dropping by 1.5%. Even tech earnings are expected to be flat quarter on quarter. So you can already tell what consensus has been doing, and what they're sort of pricing in terms of the earnings development and what they're really expecting in terms of the fallout, even during a quarter where top down we're probably seeing a lot of evidence of front loading of activity. Bottom up consensus is actually saying despite that front loading and despite that front loading perhaps helping activity, that still wasn't enough to actually keep earnings higher. So to me, when we look at the next 2 months, when we get those earnings, particularly from the mega caps, always remember the mega caps, they make most of their earnings outside of the US. They make above 50% of their revenues from outside of the US. So the weaker dollar is a massive tailwind there. I think there's a very, very decent chance that we actually do squeeze, and we do squeeze a lot higher in the next month or two after the reporting season, and particularly the tailwind from that weaker dollar. I think that is not at all baked into those earnings expectations and not priced in yet.
Is there anything you could see at 8:30 a.m. Eastern time that could change your view and make you question your thesis?
No, not really. I'm pretty convinced right now, to be honest. So, because the problem also is on the labor market. It's kind of cherry picking right now, right? Obviously, people have been looking at the ADP yesterday, but you can look also at the Challenger job cuts, and you get a completely different picture. You can look at jobless claims, initial jobless claims. Yeah, they're down a bit. Continuing claims have gone up a lot, but again, even there, when you look at 3 states, you look at Texas, Florida, you look at Minnesota. Actually, that's almost 70% of the increase that we had in continuing claims since the end of April. So very specific factors, not broad-based, right? We look even at warn notices, fine, but if you look at the warn factor, that is still within the range since COVID ended in 2021. So, there's a lot of things that when we look a little bit under the hood, the labor market weakness does not look as acute as people are sort of selling it, I think.
Hey, Max, just to put what you've just said another way, you're basically telling Lisa that you don't care what the number is at 8:30 Eastern Time. It's not relevant to you.
It's not really, because I think we've had such huge levels of uncertainty, right, in the last 3 months that I have a really tough time to compare that to a normal time in January, for example, or sometime last year. Who knows? Isn't the fact, for example, isn't the risk much bigger that, we had in April and May, we had 140 and 150K job gains, roughly, during peak uncertainty? Doesn't that introduce the risk that in the next 3 months, if we get a bit more clarity, if we get slightly less uncertainty, doesn't that really introduce the risk that perhaps we get 1 or 2 months of really strong jobs data? As much as I buy the story of, tariff-related front-loading of activity, but isn't there also perhaps companies sort of holding off on hiring, companies holding off investment with a bit more clarity, with a bit more certainty? Doesn't that also introduce the risk that companies then are actually returning to investment, returning to hiring. And I think that's where consensus is completely oblivious right now. Everyone is steadfast on no, H2 is going to slump like crazy and there's no way around it. I think there has to be a few nuances. There will be some reversal of the front loading, but on the other hand, isn't there also, from this decline of uncertainty, a bit more clarity? Shouldn't there also be a bit of a tailwind from that? And I think people are pretty much totally ignoring that at the moment.
Hey, Max, thank you, sir. We're not now. Max Kettner of HSBC on upside risk. There's an additional way of summarising what Max just said, and that's you can go on vacation right now, apparently, and skip payrolls at 8:30 Eastern Time.
Sometimes the data just seems so messy and all of the uncertainties are just so overwhelming that you can ignore them all and stick with your thesis based on a whole host of different inputs. It really raises this question: how do you strip out the signal from the noise at a time that is incredibly noisy?
The estimate in our survey, 106,000. The jobs number drops a little bit later this morning. With an update on stories elsewhere with your Bloomberg brief, here's Danny Berger. Morning, Danny.
Good morning, John. President Trump's one big, beautiful bill is onto its way to a final vote in the House. Republicans cleared a procedural hurdle to advance the tax and spending bill early this morning. Debate now underway. You can see Hakeem Jeffries there setting up a vote later this morning ahead of Trump's self-imposed July 4th deadline. We're going to bring you the latest developments throughout the morning. Elsewhere, President Trump says that Federal Reserve Chair Jay Powell should resign immediately. This after the head of the Federal Housing Finance Agency called on Congress to investigate Powell, alleging that his recent testimony to the Senate about the central bank's planned renovations to its headquarters was, quote, deceptive. And in the UK, Prime Minister Keir Starmer backed Rachel Reeves to remain Chancellor into the next election and for many years after. Yesterday, he had refused to say whether she would remain in the job until the next election. Starmer later told the BBC that he works in lockstep with Reeves and she is doing an excellent job as Chancellor. And that's your brief, John.
Danny, thank you. Appreciate it. He butchered that yesterday, didn't he?
The tear heard around the world. I mean, honestly, and it seems like unless people understand exactly why she was crying and whether she actually is going to stay, there still is some skepticism being baked.
When it was the Truss government, they blamed Truss. They didn't blame Kwarteng. For some reason, when it's the Starmer government, they blame Reeves and not Starmer.
To an extent, it also shows how much Starmer's fate politically is tied to Rachel Reeves, because he cannot just separate himself from her by saying, I don't fully back her.
We're going to have that conversation later on this hour and talk about the implications for foreign exchange. Up next on the program, the mega bill advances.
We feel very good about where we are and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people.
Up next on the program, Andy Laperriere of Piper Sandler, live from New York City this morning. Good morning. We are heading into the long weekend at all-time highs on the S&P 500 futures this morning, totally unchanged. The next stop for this market, 8:30 Eastern Time. The jobs report just around the corner. Under surveillance this morning, the mega bill advances.
It's been a good day. We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We feel very good about where we are and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. This is going to be a great thing for the country. Look forward to moving it forward.
It's the latest this morning. House Republicans heading towards a final vote on the president's one big, beautiful bill after working overnight to flip the holdouts. Joining us now is Andy Laperriere of Piper Sandler. Andy, welcome to the program, sir. It feels like we're getting closer. Any reason to believe this doesn't get done before the holiday?
Well, I think with the vote on the rule last night, the odds that you're going to have people vote against final passage are really low. So I think you should take Speaker Johnson at his word that he's got the votes.
Andy, what is in this that has become the most controversial point for Washington, D.C.? What is within the bill that seems to be the biggest issue right now in the nation's capital?
Well, I mean, you had the holdouts, I think, were really focused on two things. So on the moderate side, you had the Medicaid cuts, and on the conservative side, it was kind of a combination of the degree to which the bill increases the deficit, and then you had people like Chip Roy focused on provisions of the IRA when certain equipment has to be placed in service in order to qualify for tax credits. And I just think that when you get deeper and deeper into the process, the leverage of individual members just declines, right? I mean, you're going to, I think the leadership and the president are going to ask, well, you're really going to take this bill down because you don't like the placed in service date? I mean, this is the president's entire economic agenda here, and you're going to vote no over that. So I think, that's what we're seeing, that it is tough to vote no at this point in the process. And we'll find out a little later if they got anything overnight in terms of concessions on future things, but the bill doesn't change. And so as soon as Mr. Jeffries is done, they'll have the vote and it'll pass.
Just to be clear, Andy, that means that anyone who's professing to be a fiscal hawk right now has just been playing kabuki theater, correct?
Well, I wouldn't exactly say that. I mean, I think that they might have gone into this hoping to get some concessions, and it's possible that there is some concession, that's in the future. Some kind of promise that was made. It's hard to know, exactly what was promised overnight. Well, I think we'll find out that in the coming days. But look, I think at the bottom line is if you're a Republican, do you support extending the 2017 tax cuts? Do you support more border money? Do you support more money for defense? All the things that are in this bill, you're going to vote no because of one of your concerns. Now, obviously, the size of the deficit is a pretty cosmic concern, but you're not going to materially change that at this point in the process, or as really one individual member of Congress. I mean, I think the pieces that are in this bill are the pieces that needed to be in there for you to get a majority in the House and a majority in the Senate.
Given how significantly it does increase the deficit, how much does that really put the onus on these tariff negotiations, the trade negotiations, to raise revenue from some key trading partners? We got the Vietnamese agreement overnight. We have a host of others that might be in the pipeline. Do you expect there to be a lot of a firmer line because of the revenue needed?
I honestly think that these things are completely unlinked. I think the president wants higher tariffs because he believes in higher tariffs. And I don't think that the tariff revenue played any meaningful role for hardly any members in terms of looking at this bill. The president is not focused on the deficit. Just thinking about this bill, which does add to the deficit, the president proposed trillions in additional tax cuts and took off the table the biggest programs. He's not focused on the deficit. That's not why he's doing these tariffs. He wants higher tariffs because he believes he's a protectionist. That's why he wants higher tariffs. So I really don't think there's a link here. Also, I mean, some of these tariffs, if it works the way the president wants it to work, like the product tariffs result in bringing manufacturing back home, well, then they shouldn't raise any revenue down the road, right? I mean, the steel and aluminum tariffs, if it succeeds the way the president wants it to, it shouldn't raise hardly any money. So I really don't think this is about money. I think this is about the president trying to completely reorder U.S. trade.
Andy, appreciate the views. As always, thank you, sir. Andy Laperriere there of Piper Sandler. The next stop, of course, after we get through the tax bill, we get through payrolls. Next week, July 9th, the deadline, the self-imposed deadline to negotiate trade agreements with the United States of America. Happening right now in the United Kingdom. It's been a volatile 24 hours for British assets. Sir Keir Starmer, the British Prime Minister, speaking at the moment, saying, I have every faith in the Chancellor. We work in lockstep. Yeah, and Rachel Reeves, the Chancellor, declined to answer any questions about why she was observed having a tear running down her cheek in the Commons. And this really raises the question, what will it take for Keir Starmer and Rachel Reeves to reduce or reverse some of the sell-off that we saw yesterday in response to this feeling that maybe Keir Starmer was trying to distance himself from Reeves' policies after he did an about-face with respect to certain welfare reforms, and then it raised some real questions about the fiscal sustainability of the UK government. And then the market got him back in line.
Exactly.
We've seen that a few times so far in 2025. That's a conversation we'll have in just a moment with George Saravelos of Deutsche Bank, plus Danny Berger with your morning movers and a new member of the S&P 500 from New York City this morning. Good morning. You're watching Bloomberg TV. 2 hours away from the jobs report, just around the corner. Record highs coming into Thursday. Payrolls Thursday. It's hard to get used to. Don't get used to it. It's not going to happen again anytime soon. Futures on the S&P unchanged, on the Nasdaq also. With a few hours until the opening bell, let's get you some morning movers with Danny Berger. Morning, Danny.
Hey, John. Well, we learned that the U.S. would be lifting license requirements for chip design companies to be selling into China. It's part of the trade deal, and in exchange, as we've been learning the contours of U.S. and China's deal, they would be getting more rare earth minerals for the U.S. But in some, that means for companies like Synopsys and Cadence Design Systems that sell the software that are necessary to design chips, that they can now sell into China. For these companies, it's at least a tenth of their sales. So you can see the big reaction, 6.5%, 5.8% respectively for the companies. Also, some sell-side moves this morning. A double upgrade by BNP Exane to FedEx, saying that this company is way oversold and that it's outperforming its peer UPS. That, yes, it has competition from Amazon, but it is still outperforming in that context. So shares up 1.33%. The last one, more sort of a technical thing, probably the best name of any publicly traded company, Datadog. It designs software. They are now joining the S&P 500. Dow and S&P announced this yesterday. It's replacing Juniper, which is getting taken out because it's being bought by HPE. Because a lot of passive money flows into the S&P, that's automatically a boon for the shares. So those are up more than 9%, John.
Danny, thank you. Appreciate the update. Big rally there in the pre-market. On our radar this morning, one of our top stories, the House moving towards a final vote on President Trump's tax and spending bill after clearing a procedural hurdle. Speaker Johnson saying Republicans have the votes needed to pass the bill, despite a handful of holdouts remaining.
So a real question here is, what did those holdouts get in order to get on board? Because there are a couple of no's that turned into yes. What I find interesting is only 12% of participants in a Deutsche Bank survey thought that the U.S. fiscal deficit will significantly influence the market in the next year. And right now, it seems as though there is a level of impunity, at least in the United States, about the deficit increasing. Over time, a majority of those surveyed thinks that it will make a difference. So this sort of speaks to the different iteration and the way that people are responding to what's getting passed in D.C.
One number, 425. 10-year bond yields at 425. Which is pretty low considering where people thought we might be a few months ago.
Totally contained, and a lot of people think that as much as people cry about bond vigilantes, they don't tend to wake up until there's really a key question that arises about fiscal sustainability, and that's nowhere near for the United States. That said, longer term, you see it in the 30-year, getting a little itchy, and you can kind of expect that to continue.
Bond yields down this morning by 2 basis points on 10s. Call it 426 now, down at the front end by 2 to 3 basis points. The 2-year yield at 376. Elsewhere, the US and Vietnam reaching a trade deal after weeks of negotiations. Vietnam agreeing to a 20% tariff on exports to the US, doubling to 40% on goods transshipped through the country. In return, Vietnam dropping all levies on U.S. imports.
Yeah, although that's a little bit, I don't know, a little gratuitous given the fact that it's not as though Vietnam is importing tons of goods from the United States. So it's probably an easy ask considering all the panoply of potential options by the United States. The bigger issue here is certainty. And you pointed this out earlier, and I think it's really important. The likes of Nike, Lululemon, the likes of On Holding, all rallying because at least they understood that it was a level that allowed them to keep producing in Vietnam, where they have shifted a lot of supply chains from China, while passing on some of it to the consumer, absorbing some of it, and not being overly punitive. Certainty seems to be triumphant, even amid a higher tariff environment.
Is that how low the bar is now?
Yes.
Into July 9th?
Absolutely. It seems like people are shrugging it off, and what they've seen is it's not overly inflationary. Consumers are strong enough to absorb it on the margins, and overall, companies adapt and adjust.
The transshipping tariff, if we can call it that, you've got to do something then about Indonesia, got to do something about Thailand as well. You've got to secure all the other countries, or all that traffic, all that trade is just going to find itself going elsewhere.
Yeah, and this really raises the question, the specter between China and the U.S. as they continue to negotiate, given the fact that ultimately China's waking up to the idea that this is a key part of the negotiations for the United States with other regional players that do a lot of business with them.
Let's talk about China. The U.S. lifting curbs on exports of designed software for semiconductors to China in a sign that the trade deal between the two countries is in effect. In exchange, Beijing pledging to speed up approvals for critical mineral exports. Is this the so-called Geneva Accords from a number of months ago?
This is so deeply confusing. This was supposed to be done weeks ago in terms of getting the rare earth minerals back into the United States. Then there was the renegotiation of the Geneva Agreement where, okay, now those rare earths are going to come through. And the likes of Ford have been halting some of their production of cars because of the lack of magnets from China. Those can all restart. But Even then, the rare earth imports to the United States had been falling. So now maybe another bone will be thrown to them in the form of software tied to AI production. And maybe this time it will work. It just raises the question, who has the leverage and how far have we actually negotiated a deal between the U.S. and China?
They're going to keep fighting for that leverage, that's for sure. That's the story with trade. We need to sum up the last 24 hours in markets, specifically in the UK. Markets rebounding from a sharp sell-off in the last 24 hours. Prime Minister Keir Starmer giving his full backing to Chancellor Rachel Reeves after stoking concerns about her future in the role. Joining us now from the City of London is Bloomberg's Adam Blenford. Adam, welcome to the programme, sir. For the people who are on vacation and might have come back this morning, how would you describe what's happened in the last 24 hours?
It's been one of those intensely personal moments in politics where we sometimes have to look, a little more deeply about where the links between the pressures of the political job, the importance of international financial markets, and then the human cost of some of this also comes into focus. We saw a tearful UK Chancellor of the Exchequer in the House of Commons yesterday, as unrelated to, but at the same time as Prime Minister Keir Starmer didn't overtly give her his backing. They've had a really tumultuous week or so with the failure of a bill where they were trying to push through £5 billion of spending cuts from welfare payments. It's really pushed the pressure on her, focused the pressure on her fiscal plans and her economic plans, and the speculation was that whether that had kind of weighed on her yesterday and what was going on. Starmer then really backed her vociferously in an overnight interview with the BBC and has come out all guns blazing this morning in terms of backing his Chancellor, saying that they're working in lockstep, they're thinking in the same way, and that she's going to be in position for a very long time. That, and then even in the last half an hour, the two of them have appeared together. Starmer was there on a prearranged speech, and Reeves made a slightly surprise appearance in which she came and she mentioned and reinforced the idea that she's committed to the fiscal rules, which are part of obviously of her economic plan. Starmer denied that this was all an opportunity to try and calm the markets, but as you showed just before the segment, those international bond markets are slightly calmed this morning by what has been really a full court press to try and convince them that the economic and financial and government leadership in the UK is in place and things are stable.
Adam Blenford, over in the UK. Adam, thank you, sir. Summarising the last 24 hours, incredibly volatile in the United Kingdom. Begs the question, who's in charge right now, the Prime Minister or the 10-year gilt yield?
Right now, it's the 10-year gilt yield. If you look at the reversal, though, he'll deny that. You know, British politics, love a good drama in British politics. It seems like U.S. politics are very dramatic, but lack that same kind of level of personal drama and poignancy that we're experiencing with either a head of lettuce or the tear in the Commons.
Haven't seen tears this morning in the House, have we?
No, we haven't.
Might see them later.
Maybe from exhaustion.
From Hakeem Jeffries speaking. I think he's wrapped up, by the way.
All right, so we can expect
I saw them on their
time.
feet and applauding moments ago. We'll see. Joining us now to extend some of this conversation, not the last bit, but the bit about foreign exchange and politics. George joins us now. George Saravelos of Deutsche Bank. George, welcome to the programme, sir. This EM-type dynamic, which keeps gripping developed markets over the past, I'd say 12 months, maybe even longer, George. How are you explaining that to clients at the moment?
Well, our view is it has more to go. It's here to stay. And I think the critical driver of all of this is that fiscal deficits everywhere are going up. And of course, this was the case for the US over the last 2-3 years. But the really big shift since the start of the year is if you look at all the countries outside of the US, with the UK being one exception, but everyone's increasing fiscal spending again. Canada, Germany, China's front-loading. We're seeing discussions in Japan. And I think it's this global increase in deficits combined with sticky inflation that is creating these tensions as far as this discussion goes.
Well, George, let's talk about the tension specifically in the United Kingdom. Just yesterday, the pound and British assets getting absolutely whipsawed, presumably over the future of Chancellor Reeves. But I wonder if it's something bigger than that. Is it about her future or the inability of this government to consolidate spending?
I think there's two problems on the UK. There's the communication problem and a macro problem. The communication one is that effectively these fiscal rules, they're extremely clumsy. You see they're dependent on projections, which the OBR has 5 years out, productivity, which no one believes. And every time you see some shift in gilt yields, the market starts talking about gaps. And I think that just creates a broader problem of instability, and we see that. And then there's the broader macro problem, which I would argue applies just as much to the UK as it does to the US, which is both of these countries are running big twin deficits. And that is why you're seeing increased vulnerability to negative news. We experienced it in April in the US with the whole Liberation Day back and forth. And now we're seeing a small micro version of that in the UK. But I would say both the UK and the US have those two common denominators, external deficit and internal deficit, and that's going to be causing problems.
There's a big difference, though, between the two, and we're watching it in real time as the United Kingdom tries to figure out how to message their deficit spending and how they plan to cut or not from some of those expenditures. In the United States, Congress just keeps on spending, and they're about to pass a bill that increases the deficit over the next 10 years by some $3.5–4 trillion. Why is the U.S. such a different market when it comes to dynamics and how much the bond market is waking up to this?
So you're absolutely right. The US has had a greater degree of resilience, so to speak. But I would argue since the start of the year, you're actually seeing convergence, whereby the US is becoming more sensitive to these things. Now, of course, over the last few months, the market has calmed down. But let's not forget what happened in April. And I would say a key driver of why the market has calmed down is because we've had some downside surprises to inflation. And of course, the bond market is most sensitive to those inflation surprises. So let's see what happens over the next 6 months. But between the UK and the US, I'm a lot more concerned about the US, because if I look at the shocks hitting the system at the moment, in the US, not only do you have the tariff discussion, which everyone is so focused on, but the bigger underlying shock, in my view, is the labor market, where you're seeing a very sharp reduction in immigration, which is equivalent to a sharp slowdown in growth and potentially upside surprises to inflation. And that is the worst mix if you're thinking about debt sustainability and the funding of those twin deficits. So the immigration story to me is much bigger than the tariff story as far as the US goes.
So, George, if we could just sort of solidify this parallel. If you see the United States as being a more significant story and, frankly, a worse story than the United Kingdom, which is experiencing a lot more real-time volatility in their markets, what do you think will be, A, the breaking point, and B, the consequence for both the dollar and long-term yields that have been relatively calm amid this process?
So there's two ways this can get resolved. As you say, it can either be a calm way or it can be a disorderly way. The calm way is what we've seen over the last few weeks, where the dollar weakens. As the dollar weakens, effectively assets cheapen up. You can draw in those marginal buyers. We also authored a piece talking about a Pennsylvania plan, which effectively, I think, is being realized. The US Treasury shortens the issuance of duration. The domestic banks, the pension funds absorb the debt, so foreigners can disengage from the bond market. I think that's the orderly plan. The disorderly one is if the negative supply shock I was discussing becomes more acute, you get much bigger inflation surprises. And at the same time, Fed independence gets challenged. And we're seeing that in the background, well, arguably not in the background, in the foreground with some of the statements. The reason the market's calm is because inflation is calm. But if that growth inflation mix worsens, that fiscal dominance question, I think, will come back to the fore very, very quickly. And that's where you get the tipping point to disorderly dynamics.
Yeah, George, I'm pleased you corrected yourself, because it's certainly not happening in the background. The president's not being subtle about it at all. George, thank you, sir. George Saravelos there of Deutsche Bank on a jobs data, on a payrolls report a little bit later, and on this Federal Reserve.
You know, Deutsche Bank put out a report just talking about George, saying that only 16% of respondents believe that the Fed is completely independent. That, to me, was shocking.
That's a problem.
That is a big problem. 25% think that political pressure will lead to lower rates, and you have seen rate expectations come in the more that President Trump jawbones Fed Chair Jay Powell.
The immigration story is huge.
It is.
Massive for the number later on this morning. That's the big debate happening stateside. If you're just tuning into this and maybe you're sitting outside the United States looking in, it's a big conversation about just how much immigration has been reduced, what that means for the so-called break-even rate of the labour market. Maybe we only need 100K in jobs growth and unemployment can still hold pretty steady.
Yeah, and to build on that, this idea that George was talking about, and we saw this in the JOLTS data on the margins, the idea that job openings were growing because potentially people were losing services jobs from immigrants going home. and wages may be going up just a touch because people had to offer more to bring domestic labor on board, raises the question of that kind of stagflationary mix that George was talking about that becomes very hard to counteract.
106 sounds low. It might not be called weak later on this morning. 106,000 is the estimate in our survey for payrolls at 8:30 Eastern Time. The previous number, 139. With an update on stories elsewhere this morning with your Bloomberg brief, here's Danny Berger. Hey, Danny.
Hey, John. President Trump's one big, beautiful bill is on its way to a final vote in the House. Republicans cleared a procedural hurdle to advance the tax and spending bill earlier this morning. As you can see, debate is still underway, but once that finishes, it sets up a vote later this morning ahead of Trump's self-imposed July 4th deadline, and we will bring you those developments as they happen throughout the morning. Elsewhere, Microsoft is cutting about 9,000 workers, or less than 4% of its workforce. It's the second major wave of layoffs this year as Microsoft looks to rein in costs while ramping up AI spend. The most recent cuts are meant to streamline process and management layers. Microsoft also cut 6,000 workers in May. And some tragic news in the world of sports this morning. Liverpool football star Diogo Jota has been killed in a car accident in Spain. The 28-year-old father of three married his childhood sweetheart less than 2 weeks ago. Jota's 26-year-old brother, Andre, also a professional footballer, was killed in the crash. Really tragic news this morning, and that's your brief. John.
Hey, Danny, thank you. Absolutely tragic. Up next on the programme, watching the hard data.
The data has been so resilient. So I think that the cuts really can't happen unless you get actual hard data that begins to fall in line with the soft data that we've seen, where there's been quite a bit of weakness.
Up next on the programme, we'll catch up with Sarah House of Wells Fargo. Unfortunately, this might be a long morning. Tracking events down in Washington, D.C., I can confirm that the House Minority Leader, Hakeem Jeffries, is still speaking. He's still going. And he might still be going in a few hours' time.
Yeah, our understanding is he's currently going through some Medicaid stories as he prepares for the final vote of this bill.
What is the objective here? What is the purpose of just talking for this long? Who's it for? The American public or for his peers, his colleagues in the House? What's this about?
I mean, yes, this is sort of the evergreen question, right? A lot of the grandstanding, the little clips, a lot of the testimony that we see with Jay Powell that we wonder, why did that person ask that random esoteric question and then not let the person finish because they want to clip it and put it on social media? And so, yes, that seems to be where we are today.
The House is slowly getting closer to a full final vote on the one big, beautiful bill, making some progress overnight. Have some more thoughts for you on this throughout this morning. Elsewhere, waiting for the jobs report. That should drop on time at 8:30 Eastern Time. Equity futures at the moment on the S&P just about positive on the S&P 500, higher by 0.02%. Under surveillance this morning, we're watching the hard data.
The data has been so resilient. So I think that the cuts really can't happen unless you get actual hard data that begins to fall in line with the soft data that we've seen, where there's been quite a bit of weakness. If we see a sub 100,000 job and certainly a negative jobs number, that would start to create the narrative of weak, hard data that would allow the Fed to cut rates.
It's the latest this morning. Investors counting down to the payrolls report out in less than 2 hours' time. Wells Fargo cut its outlook to 100K from 115 after the ADP report showed a surprising decline. Sarah House of Wells Fargo joins us now for more. Sarah, welcome. A lot of people have come on the programme in the last few days and said, ignore the headline number. How misleading might the headline number be later this morning?
Yeah, so I think you really need to dig into the details of this report. So, we saw a decent headline number last month, but as under the surface, you saw really narrow breadth. I think so that's another important facet we'll be looking at, as even as the break-even rate of non-farm payrolls may be slowing, you still need to see a widespread growth across industries for it to be durable, and that's just something we haven't seen. I think the other thing you'll need to be watching is what actually happens with the unemployment rate. As the Fed officials, we've already seen that move towards the top end of where they think full employment is. And so I think seeing that drift up further, I think could progress these discussions of, okay, maybe we do need to begin cutting rates over the next couple months.
Sarah, you mentioned that process, the so-called break-even rate may be coming in, maybe lower than it was 12, 18 months ago. How much lower? What kind of number are you and the team thinking about?
Yeah, so when we look at the immigration effects and just the fact that you're likely to see an outright decline in the immigrant population this year, so you were thinking probably somewhere around 90,000. So, we had a report out yesterday from the AEI suggesting that it could be significantly lower, even somewhere down 40,000. But I think right now, probably sub 100,000 is where we're looking at, just given some of those immigration dynamics, as well as just the slower growth in the native population that we've seen.
Sarah, just to build on what George Saravelos was talking about, he thinks that the market is not counting enough the sort of stagflationary ramifications from the drop-off in immigration, the idea that it could reduce productivity, in effect, and increase costs, the inflationary boost that people don't want to see. Do you think that the numbers back that up in any way?
Well, I think if you look at the distribution of foreign-born workers in the economy, so a lot of them in ag, a lot of them in construction, so in some cases areas that are harder to actually see some significant productivity gains. And so I think, especially when you look at construction, that's already a fairly tight labor market as well. So certainly the potential to see upward pressure on there. Other areas like leisure and hospitality, again, where it's maybe not quite as easy to see some additional productivity gains. And so I do see that as a potential offset to the broader headwinds that we're seeing in the labor market right now, coming from still tight monetary policy and, of course, still a lot of economic policy uncertainty.
We started this hour with Max Kettner of HSBC saying that he didn't care what happened and that he didn't actually think that it mattered what the numbers show because they'd been so messy and he'd already drawn his conclusion from other numbers. Can you give us a defense of why this number matters?
It's a piece of the puzzle, and it's a very important piece, but I agree that the NFP numbers, you have to take them in some ways with a grain of salt, especially that first print. So we saw that pattern of downward revisions reemerge. We're seeing still a pretty significant gap with the QCW data that inform those benchmark revisions. So all of that point to the payroll gains recently still being overstated. And so I think it's reasonable you still want to pay attention to this headline number. It's still generally considered the gold standard. The Fed puts a lot of weight on it, but understanding that this is, again, just one piece of the overall labor market puzzle.
Sarah, thanks for your view on things. Sarah House there of Wells Fargo, looking ahead to the payrolls report later on this morning. How many people have told us to ignore the headline number and just focus on unemployment? Focus on that one data point, and that'll tell you a whole lot more.
Yeah, and a number of people will argue that even don't focus on that. Maybe we should have gone to the beach, John. What were we thinking? Because essentially one person after another says that things have gotten so noisy. What's the point anymore?
Max is just ignoring it all, right? Over at HSBC. Apparently the labour market doesn't matter to him.
Well, it's sort of this question of which data matters, especially if you have downward revisions down the line or potentially upward revisions. Key point that I think is you have a lot of very smart people who have been coming out saying opposite things, looking at the same data. And that, I think, points to the confusion of the moment that we're in.
Torsten Slok of Apollo will join us on the programme a little bit later this morning after we get the payrolls report. After Mike McKee has broken those numbers, Torsten will respond to them. He just put this out. Unemployment rate is expected to move higher. That's his call for this morning and maybe beyond in the next several months.
Yeah, so how much higher for the market to wake up to it rather than just say, OK, time for the beach?
Torsten is with us a little bit later this morning before, of course, we all head to the beach. Up next on the programme, Priya Misra of JPMorgan, Bloomberg's Tyler Kendall, Sarah Wolfe of Morgan Stanley and Michael Collins of PGIM. The second hour of Bloomberg Surveillance is up next.
In general, we think that momentum is still positive. And again, we would be overweight risk assets.
If you're walking into the bond market, you have to do it with open eye.
I hope the third quarter is nothing like the second quarter. I would love that quarter over again. We're not going to get it.
The tail risks have been trimmed off and the worst cases have been walked back.
People are underappreciating the risk to the upside.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
It is Payrolls Thursday, 90 minutes away from the jobs report, heading into the long weekend at all-time highs on the S&P 500, at least so far. Equities this morning slightly positive on both the S&P and on the Nasdaq 100. Going into this at 8:30 Eastern Time, the estimate in our survey, job gains, payrolls growth of 106,000. The previous number, 139, and a lot more attention on the unemployment rate.
Because there is this mismatch of, are we just seeing an entire labor market that is shrinking, contracting, as immigrants do not come into this country and continue to migrate out? This is really the key question. Do we understand the dynamics of a labor market that is so dramatically in flux that not only do you have the immigration picture, but you've got the AI picture, and then you have the hesitation of a lack of certainty around policy that's hampering hire plans? You put this all together, and you've got Max Kettner going to the beach early because it is so confusing that some people are just discounting it altogether.
The chairman of the Federal Reserve can't go to the beach early. He's been called out already on social media going into this number. Too late, his nickname from the president, should resign immediately, apparently. If you look at the dual mandate at the moment, inflation around 2%, full employment, we have got to have the debate, which side of the dual mandate right now is most at risk?
Yeah, and that ultimately is a debate that they don't have the answer to. They do, though, lean into the idea that the labor market in the U.S. economy is strong enough to give them the luxury of waiting it out and getting more data, potentially those 3 CPI prints before the September meeting, as a number of different Fed members have indicated. This is a point of disagreement. There are a lot of people in the market who agree with the moniker too late, even though, by the way, Too Late Powell has just turned into Too Late. That's actually a name. Is that really where we are right now?
Apparently, yeah. Chairman Powell himself acknowledged that he was a little bit late last year when he started reducing interest rates. So maybe he's going with that.
Okay, and pretty much no one in markets agreed with him that it was too late because the market saw inflation.
Some people thought it was too early.
Some people thought it was too early. Some people thought it was too much. It just points to the fact that we're in a deeply uncertain moment. And really, people are questioning the fundamental argument that this is a strong U.S. economy that can withstand interest rates at these levels. That is a crucial debate, and it is being muddied by the political overlay of, oh, yeah, you reduce it to 1%, that benchmark rate, we can borrow then, and then we can lower the overall costs of the U.S. government debt market, which no one really is thinking is going to happen.
You've mentioned Max Kettner of HSBC a few times. He joined us about an hour ago, basically ignoring the jobs number at 8:30 Eastern Time. And I think that speaks to a lot of investors at the moment, ready to move on. Ready to move on from the tax bill, which a lot of people assume will pass later on this morning in the House. Ready to move on from the trade story on July 9th. We've brought up Vietnam a few times now. The fact of the matter is, this market has been so anchored to the extreme that they're willing to accept a 20% tariff on Vietnam just because it wasn't 46, the 46 we heard on April 2nd.
Sorry, I'm so glad you said this, and I apologize in advance because I want to take out my little soapbox, get on top of it, and start, but I'm not going
Grandma.
to.
We've got all morning.
No, we don't have all morning, and everybody will turn off the TV if they haven't already, but there is this question of what does all priced in mean? Right? Is it just being pegged to an extreme? Is it that people have gotten so burned by trying to short anything or to sell anything that they don't want to do it again? And so they say everything is priced in and they are just benumbed to the different realities. Is it because people are sick of being bearish? What does priced in mean at a time when we don't even understand where we are economically to the degree where people are ignoring a labor market report that typically was the linchpin of so many economic projections? I'm done. Thank you.
Set the slow clap. No, I'd give you a fast clap. I'd give you a fast clap.
Okay.
Conditioned by the experience of the past few months.
Yes.
Sick of missing out on gains.
Yes.
To see the market hit the lows of April 8th, then rally 20% plus on the S&P,
Amen.
more than 30% on the NASDAQ. That will reinforce behavior. That will condition you. You know what changes it? Data.
Yes.
When you start getting hit around the face with data that moves in the other direction, that's when you start to wake up.
And to build on that, how much has this market become more vulnerable to a downside shock because of that conditioning? And this sounds really gloomy, so I'm going to stop because it's not necessarily gloomy.
Nobody wants you to stop this morning.
Well, but there is this feeling that I don't know how prepared a market is for a downside surprise of the economy at a time where people feel pretty good about everything.
Equities on the S&P, just about positive. The jobs report, about 86 minutes away. Coming up this hour, Priya Misra of JPMorgan, with stocks hitting fresh all-time highs. Wolfe of Morgan Stanley counting down to payrolls, and Mike Collins of PGIM, with President Trump continuing his attacks on Chairman Powell. We begin this hour with stocks higher. Investors counting down to the payrolls report, due a little bit later this morning. Priya Misra of JPMorgan writing, it's a low hire, low fire labour market. Economists expect the slowing in hiring to continue, but if the monthly pace is lower for the break-even rate and the unemployment rate is around 4.3%, there is no urgency for the Fed to cut. Priya joins us now for more. Priya, good morning.
Morning.
The Fed chair says the economy is solid. Will we see that at 8:30 Eastern Time?
You know, I think we'll see a slowing. All the soft data has been suggesting slowing. The labor differential is sort of worsening. I think while it's clear it's slowing, what's the level? If it's 100,000, even I would say 90,000, that's in line with consensus. That's in line with potentially a new break-even rate that's much lower. So we're going to look at average hourly earnings. We're going to look at that distribution of those payroll gains. We're going to look at the unemployment rate. If it's 4.3, what Chair Powell's been saying is this is a resilient labor market. There is, there's no inflation pressure. That I'm going to be watching because, I think inflation is the reason why the Fed is not reducing the level of restrictiveness. But if it's an okay economy, they're going to wait because they know the tariff impact takes a while. It's only been 3 months since Liberation Day. The Fed knows that goods inflation is likely to pick up. So they'll want to see how persistent is that, what happens to service inflation. So if the labor market's okay, their urgency to cut goes down. I think the front end is a little vulnerable in that scenario, but I still think it's asymmetric, meaning if you get a 50,000 payroll, we look at the unemployment rate, but that 50,000, I don't think anyone's saying, thinking that it is going to spook the market. It's going to spook not just the rate market, it's also going to spook the equity market. That's in this soft landing la-la land. I think there's some complacency there.
Which is what Lisa's going nuts about already this morning.
Okay, the soft landing la-la land, it's not totally fair. There's real AI, but yeah, it seems like people are very rosy.
Before we get into the market, can I just pick up on that word slow? We've had this debate all week. Slow is not necessarily weak. There are structural factors, cyclical factors. If we get a slowdown in payrolls growth, is that the consequence of immigration or the slowdown in the economy? Which one is it?
I think it's both. That's not a cop-out answer. The reason for that is the structural weakness you could see even before the immigration drop. If you look at last year or the year before, it was a highly concentrated labor market, meaning it was education and health, it was leisure, hospitality. That's the structural aspect you're talking about. The new graduate hiring, why is that so weak? That's maybe the AI story. So I think, those are the structural aspects. Now, where is immigration kicking in? We haven't really seen it in construction, but that would be one area, leisure, hospitality. We're seeing it a little bit in jolts. So I think it's a confluence. I mean, that's what we've been dealing with all year, is a lot of these structural factors and the cyclical, and the market has to sort of price both in. But I think on the labor market front, the slowing is both. We're going to see, I think the immigration one, the Fed might not worry that much about, because if they're leaving the labor force, is there actually some wage pressure that's picking up? The structural story is one where they have to be concerned, because that means that wage pressures in the rest of the economy are not high. That can allow them to maybe look through this, tariff-related increase in inflation that we're likely to get.
Here's one reason why I actually believe what Max is saying, and as much as I've been gloomy, I understand the view that the U.S. economy can adapt and adjust and roll through this without some sort of significant downturn. We've seen these economic cycles that are different from one another depending on the industry, and we've seen them operate at different times with the cyclical versus some of the structural issues. And that's been a help because it's actually kept a floor under how low and how weak the economy could get. Do you see that going away, or is that going to be a feature that continues to support this market from some of the worst case scenarios?
So you bring a great point. I think businesses, if they have a little bit of certainty, they can plan, which is why I think the market cheered the Vietnam deal, which I saw and said, oh, it's 20%. That's higher than what we thought. We thought it was going to be 10% on the rest of the world, maybe 25, 30 on China. This is 20 plus 40% on transshipment. And then I thought maybe the market just wants certainty. I think businesses know that's what they're paid to do, to manage around the new rules of the game. So if they know what the new rules of the game are, I think that they can plan around it. The problem is uncertainty is it a feature or a bug? I would say it's a feature of this administration. Secretary Besson has called it strategic uncertainty. Are we going to have all the certainty around trade? Unlikely. Are we going to have certainty around deregulation? Maybe taxes, we'll get some certainty that taxes are not going up. Everyone expected that. So, but to your earlier point, I think private sector balance sheets are healthy. So which is why I think the economy's been able to withstand high, interest rates for the last few years. There was a lot of fiscal support as well. Fortunately, fiscal support's not going away. So, I don't want to sound too negative. I just think that growth is likely to be below potential. Recession is not our base case as long as the tail risks that have receded and the markets price that in. As long as those tail risks don't come back, we get some certainty. I think we're looking at a 1% GDP, that soft landing below potential growth. I think that's our base case. But I do worry the more uncertainty we live with, the more companies remain frozen, and consumers, look at consumer spending in the first half of this year. It's not been strong. It's the weakest since 2009 if you exclude COVID. Consumers step back and companies step back, and then not doing anything is saying something.
Right. We are getting some certainty, though. And right now, as soon as we finish with the magic minute in Congress with Hakeem Jeffries, we might get a vote, and then we'll get a bill that actually does get passed. And we will bring forward some of that stimulative effect, as you were talking about, the fiscal impulse not going away completely from Washington, D.C. At what point do you worry about what George Saravelos is worrying about, the sort of twin deficit experience that we're seeing over the United Kingdom coming to the United States? Because we're not really seeing that dynamic right now.
We're not. Now, a couple of points on that. On the twin deficit issue, that is a long-term structural issue. It's the reason why we need foreign capital. We've got a current account deficit, we've got a fiscal deficit. So we need foreigners to buy U.S. assets. Our view is that is still happening. All of the data since April suggests that where auctions are fine, take data, custody holding, we are seeing investors hedge FX, and that's why the dollar continues to weaken. Now, the question is, markets are forward-looking. Will that continue? I would say if the U.S. economy remains solid, if some of the uncertainty goes away, we're still the deepest, most, liquid capital markets in the world. So I think foreign capital coming into the U.S. remains. So I'm less concerned around that de-dollarization around U.S. assets. But the other issue with the twin deficit is we are earning a lot in tariff revenues. I mean, I'm not talking about whether tariffs are a good thing. The economist in me doesn't love the idea of tariffs, but it's going to raise, according to the CBO, $2.8 trillion over the next 10 years. The fiscal bill is worth about $3 trillion, like fairly close, though the math works out. If you think that the end game, you look at the signal from the noise, is we're going to have some tariff on the rest of the world, 10, 20%, a higher number on China. That's going to raise revenues. And that twin deficit problem becomes a little less concerning than it was 6 months ago, because yes, the deficit's an issue we've got, and that's why I think tariffs are not going away. It's very appealing to Congress and to the administration if they're able to raise money through that tariff channel. So I'm a little less concerned. The UK needs to take hard decisions.
We'll talk about the UK another time. Your point on the US and tariffs, nailed it. The biggest test of the Democrats the next several years, what do they campaign on? When the money starts to trickle in, are they going to campaign on removing these tariffs? We saw what happened last time around with China, didn't touch them. This time around, they're going to be a whole lot higher, but when you start to get that income, are they actually going to campaign on removing those tariffs?
This is the reason why people say it's so hard to remove tariffs, because you are structurally changing the way that the United States earns money. And after Smoot-Hawley in the 1930s, it took a very long time to get those tariffs off precisely because of this. It is politically unpopular to raise taxes in order to offset any kind of income that you're getting from tariffs. And that's essentially what the Democrats might have to do.
A few months ago, Priya Misra of JPMorgan was on this programme and called the 30-year bond a risk asset. What do you think the next question is going to be? In the next segment, Priya Misra of JPMorgan is going to stick with us. That risk asset this morning, yields are lower on it, down by a basis point, a 30-year at the moment, 4.79. With an update on stories elsewhere, with your Bloomberg brief, is Danny Berger. Hey, Danny.
Hey, John. The House of Representatives is on track to pass President Trump's one big, beautiful bill this morning, ahead of Trump's self-imposed deadline of July 4th. Minority Leader Hakeem Jeffries, you can see there, has been speaking on the floor and has been going at it for more than 2 hours. Once he's finished, voting will begin, and we'll bring you all those developments as they occur throughout the morning. President Trump also says Federal Reserve Chair Jay Powell should resign immediately. This after the head of the Federal Housing Finance Agency called on Congress to investigate Powell, alleging his recent testimony to the Senate about the central bank's planned renovations to its headquarters was deceptive. The Trump administration has lifted chip design software curbs on China. The move comes as Washington and Beijing implement a trade deal. The U.S. Commerce Department informed the world's 3 leading chip design software providers that they no longer need government licenses to do business in China. And that's your brief, John.
Danny, thank you. This is why a lot of politicians become news network anchors. You know why? The most fearful word in your ear when you have to anchor a TV show is when they say the guest is not there.
Yeah.
And there's 10 minutes on the clock and you hear this word and it says stretch.
Right.
And you just have to make things up for about 8 to 10 minutes. Hakeem Jeffries would nail it, wouldn't it?
Yeah, although I don't know if anyone will still be listening.
Stories.
It's true. I mean, honestly, I was actually thinking they'd be very good at, bloviating for long periods of time, although people behind them might be sleeping.
What's the channel the Democrats go on? Where they sort of get a job there afterwards? What's it called?
You're not putting this in.
No? All right.
No.
Up next. We're nearing the finish line.
We feel very good about where we are, and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people.
Up next on the program, Bloomberg's Tyler Kendall, live from New York City this morning. Good morning. Equity's just about positive so far this morning by close to 0.1%. No drama here whatsoever. The drama down in Washington, D.C. at the moment, working overnight in the House under surveillance this morning. We're getting closer to the finish line.
It's been a good day. We're in a good place right now. This is the legislative process. This is exactly how I think the framers intended for it to work. We feel very good about where we are, and we're moving forward. So we're going to deliver the big, beautiful bill, the President's America First agenda, and we're going to do right by the American people. This is going to be a great thing for the country. Look forward to moving it forward.
Here's the latest this morning. House Republicans moving towards a final vote on the big, beautiful bill ahead of President Trump's self-imposed July 4 deadline. Bloomberg's Tyler Kendall joins us now for more. Tyler, can you confirm that the minority leader is still speaking?
Yeah, hey, John, he is still speaking. He's afforded something known as the magic minute, which means he could go as long as he wants. He started at 4:54 a.m. Eastern, so we are well beyond the 2-hour mark. Now, I'll let somebody else weigh in on how effective this is as the House really approaches nearly the 24-hour mark of being in session. But he's not talking to his tired colleagues. He's trying to talk to the voters because Democrats are going to use the one big, beautiful bill as their campaign messaging during the 2026 midterms, because the package at the moment does appear poised to pass. Because once Leader Jeffries is done speaking, House Speaker Mike Johnson is afforded the opportunity to start. It's unclear if he would take it because Republicans want to get this done as soon as possible. So our assumption is they're going to start voting on finalized passage once Jeffries is done. And the magic number here, as you well know, is going to be 217 votes. House Speaker Mike Johnson can only afford to lose 3, and it looks like he does have the votes. If we take the vote on the rule earlier today as any indication, he had 219 Republicans on board. But, John, that meant that one Republican was a holdout and didn't vote for it. And it wasn't a House Freedom Caucus member. It wasn't a fiscal hawk. In fact, it was Congressman Brian Fitzpatrick. He represents the 1st Congressional District in Pennsylvania, and he raised concerns about how this package makes changes to Medicaid. I will point out that he represents a district that President Trump actually lost in 2024, which brings us right back to this conversation about how this will play heavily in the midterms.
Tyler Kendall, stay close. We'll come back to you when this starts to progress and move forward a little bit more. Priya Misra of JPMorgan is still with us around the table. Priya, I promise you that question. The 30-year bond in America, you called it a risk asset. Is it still a risk asset?
It is a risk asset. It's got much more duration than the 5-year or the 2-year. But are you getting paid enough for that risk? That's what markets do. We look at risk and we see return and we say, are you being compensated enough? That compensation has gone up significantly. How we look at compensation, I mean, I don't want to bond geek out here. Term premium has gone up. But let's look at the curve. The curve, the Fed funds to the 30-year curve, over 100 basis points, or 2-year, 30-year. Rarely the curve is higher than this when Fed funds is high. Has the curve been 200 basis points? Absolutely. If Fed funds is at 0, then the 10-year could be 2%, 2.5%. The long end can be higher. The curve has steepened. The market has understood that the long end is not should price in more fiscal risk premium, more inflation risk premium. 2 months ago, when I was much more negative on the front end, on the long end, I was worried about, can the president fire Chair Powell? Is there the Sell America trade? Is that going to take off? Are we going to alienate all investors who want to buy U.S. assets? I think some of those tail risks have been taken away, along with other tail risks. So now I think the long end on a rate basis actually doesn't look that bad. Can that curve keep steepening? Absolutely. If you get weakness in the data, I think the front end is going to be more sensitive to that. The curve likely, continues to steepen. We like the belly of the curve. But on a rate basis, 480 on the 30-year is not that bad.
How much is this a global story? And it has to do with the United States, but also has to do with Rachel Reeves, and also has to do with what's going on in terms of Friedrich Merz.
Yeah, I'm glad you brought that up. I meant to say, term premium also tends to be globally correlated. You see this in Germany, you see this now in the UK. Yesterday was a reminder of 2022. Fortunately, the market seems a little more stable today, but there is increasing fiscal stimulus globally. There's also this question of demand for duration. And I think what we're seeing, DMOs or treasury departments globally will have to decide how much do they want to issue in the long end versus the front end. The US is going to have to make that, US Treasury has to make that decision as well. I think as that term premium, as the curve keeps steepening, you're going to see, yes, there's fiscal premium, but you're going to see not just in the US, globally, and we've seen some signs of that in Japan, where these treasury departments are going to say, let's just issue a little bit further in the curve. That'll bring that supply-demand, better in balance. But absolutely, I think yesterday was a perfect example. We had a weak ADP number. Now, ADP, I don't know about its predictability for non-farm payroll, but as its own series, it is weakening. And what did the bond market do in the US? It looked at the UK, it looked at Germany, and it said, okay, rates have to be higher. So we have to keep an eye on everything happening domestically, but also internationally. And this higher term premium, steeper curve, that's a global phenomenon, and it's absolutely going to feed through into the US.
This is a conversation for the long end of the curve. Let's come all the way in to the front end of the curve. The Treasury Secretary, Scott Bessent, speaking just moments ago to the American press and saying the following. 2-year Treasuries are telling you that the overnight rate is too high. So Fed funds right now is a range of 425 to 450. If you can bring up the 2-year on the screen, that is sub 4% at the moment. And I wonder from your perspective whether you would put some weight on the argument coming from the Treasury Secretary this morning, that because the 2-year yield is so much lower than the Fed funds, that ultimately 376 is screaming that the overnight rate is too high.
I think that's the market telling you what the Fed is also telling you. So yes, I would agree with Secretary Bessent, but that's in line with Chair Powell, with the dots. I think we talked about the urgency to cut is not there with the labor market where it is, with all this inflation risk. You fast forward 3-4 months, and we do think the inflation rise due to tariffs is going to be one time. We're seeing service inflation. I think this was the good news of the last 3 months. Apart from the tail risk being taken away, that's service inflation, housing inflation, ex-shelter service inflation is declining. And so if that continues, the Fed can start to normalize policy. That's soft landing cuts, though. That's not what the president wants. The 200, 300 basis points, that's not the amount of cuts that the market's pricing in or the Fed's telling you. But getting down to neutral, whether it's 3 or 3.5%, that's essentially what the 2 year is pricing in. And I think it's fair. I think the market will be very much on board. I don't think that's a politicization of the Fed. That's the Fed doing their job, looking at the dual mandate and saying, let's slowly get down to what we think is neutral.
The Fed committee seems to be a little off on judgment. The words of the Treasury Secretary earlier on this morning.
Yeah, when he was asked whether he wants Jay Powell to resign, he said that there are a lot of strong candidates for Fed chair, and he expects to name 2 of them later this year. It raises this issue. This is an economic debate that is very real about whether or not the Fed is behind the curve or whether it can afford and should be waiting for a lot longer. To overlay politics into this just adds another layer of complication, and I think a lot of people in markets are trying to grapple with both. Does this question the independence, or does this go to the economic debate that a lot of really strong economists are debating right now?
Priya, this was great. It's good to see you. Priya Misra there of JPMorgan. Coming up on this programme, Sarah Wolfe of Morgan Stanley as we count down to the payrolls report. Plus, Danny Berger with your morning movers. Software technology companies jumping as the US lifts export curbs on China. Equities on the S&P positive by 0.1%. We're 60 minutes away from the jobs report in America, 2 hours away from the opening bell. Looking at your morning movers this morning, here's Danny Berger. Morning, Danny.
Good morning, John. Well, we learned that companies received from the Trump administration news that they would be able to sell design for chip makers into China without needing a license. Now, that is a change, and it is part of the trade deal between the U.S. and China. In return, the U.S. gets some of those critical minerals, but those companies that sell into China from the U.S. are rallying in the pre-market. You can see Synopsys up more than 1.5%, as is Cadence Design Systems. We also got an upgrade from Morgan Stanley to a regional bank this morning, that regional bank being Valley National. Morgan Stanley saying that it is trading at a steep discount, that things have improved, like its balance sheet, like its reduction in exposure to real estate, but the market hasn't fully realized that, so goes to an overweight, and shares are rallying 1.8%. Now, I mentioned in the last hour that Datadog is rallying because it's been added to the S&P 500. Well, there were expectations. Some banks flagged Robinhood as maybe one of the stocks that also could have been a candidate to be added to the S&P 500 as Juniper gets taken out. But because Robinhood wasn't added, we are seeing shares fall 1.6%. This just usually happens because passive money goes into the index. And so Robinhood had been rallying on the expectation that it might go in. John.
Danny Berger, thank you. Appreciate the update. More from Danny later on in the program. On our radar this morning, one of our top stories, House Republicans nearing the finish line, moving towards a final vote on President Trump's big, beautiful bill. Debate continuing this morning with a potential vote on deck later ahead of Trump's self-imposed July 4th deadline.
Yeah, and the debate being Hakeem Jeffries with himself in the book that he has in front of him during the Magic Minute that's gone on for a couple of hours now, and it looks like he's got about half the binder left to go through. This raises a question about, A, what people were offered to get on board who were potentially no's before this was going through the House, and then B, the market's reaction to this, seemingly pretty sanguine about the deficit and how much this might increase it. Priya Misra actually being constructive, saying that, honestly, this is looking like you're going to get a lot of revenue from tariffs that's not being counted in this. It might not be as deficit driving as people are expecting.
Still called the 30-year a risk asset, but likes that risk at 480, the yield right now on a 30-year bond.
Yeah, seeing maybe yield steepening, but a Fed that might be more poised to cut. A lot of questions around the level versus the relative value and versus the relative level tied to the short end. Very complicated. Nobody wants to really get into this on a Thursday morning when they're looking to get to the beach.
We are looking to get to the beach at 8:31 Eastern Time, 1 minute after the jobs report a little bit later. The pressure already building on the chairman of the Federal Reserve, the president going into this jobs report, saying that too late, should resign immediately. I said this in the last hour. You know, the president typically gets to see the numbers the night before. And when this came out, a lot of people did ask, has he already seen the jobs number ahead of time?
Which, you know, goes to a question that you asked earlier this week, where you said, how are they going to message a negative number? Are they going to talk about the immigration story, or are they going to talk about how the Fed needs to be cutting rates? I'm not going to speculate as to whether the president is responding to premature numbers that are potentially market moving, but there is this larger question of how much is the pressure building politically and how much is the pressure building economically for Fed Chair Jay Powell to potentially move sooner at a time when there are a lot of question marks about the trajectory of this economy.
None of us know what the job number is going to be. Be very clear about that. I have been surprised that we haven't seen much outreach from the likes of Kevin Hassett, the NEC director this week, who could have come out and said, look, this is a different economy to the economy in years gone by. Immigration is a whole lot lower. And then just describe the concepts. Explain to people that you could see a run rate of 100K in jobs growth, maybe even lower, but you won't see unemployment go up. And it might not weigh on wages either. And explain why. Walk people through that dynamic. Otherwise, you're chasing your tail. If we come out with a number in 60 minutes' time and it's 50K, everyone will just say that's a really, really weak number. This economy is doing absolutely awful. But I think there's another argument to make there. And a lot of economists on Wall Street are already making that argument.
But it's nuanced. It's a difficult one to message. If you say the reason why we're not growing faster and seeing more job creation is because of Fed Chair Jay Powell, it's his fault, he needs to do something, is a much easier, simpler message than it's actually a complicated rearrangement of the immigration backdrop. As immigrants leave, you have this number that actually is going down, and that leads to potentially a low headline number, but it still means that it's a solid labor market. Doesn't really fly in headlines.
I know it doesn't work for Truth Social posts, but that is the job of the NEC director. Just to communicate some of these issues. Anyway, hopefully we can catch up with Kevin Hassett sometime soon. Let's talk about the UK. The UK Prime Minister, Keir Starmer, saying Chancellor Rachel Reeves will stay in her role for years to come, giving her his full support, hours after failing to guarantee her position when asked in Parliament just yesterday. The gilt market all over the place in the last day.
Yeah, the fear that Rachel Reeves was getting pushed out for having too much fiscal discipline that she was trying to foist on the UK market. Rachel Reeves currently speaking to broadcasters in Parliament. She said that she's not going to comment on the personal issue, but she said she's just cracking on with the job. And she denied that the emotional display was tied to the Prime Minister. I just wonder whether the genie's out of the bag. You have a prime minister that's trying to cater to a labor department, a labor party that wants to see ongoing welfare payments, and a whole host of people who would like to see the same at the same time that you have a deficit that is potentially constrictive and growth cooling. It is a very difficult, toxic recipe for the British government.
It's hard not to draw the conclusion that the Prime Minister looks weak this morning. Given the opportunity to back his Chancellor yesterday, didn't take it. Bond market had its say, he backed away.
Yeah.
So to say this is not about the bond market, come on.
It's all about the bond market in the United Kingdom. We saw this in 2022, and we just retested that. It is notable that even with the pushback that we have seen from Keir Starmer, you haven't seen a full retracement in the bond market, in the gilt market, back to levels before yesterday.
Let's bring it back to the States and turn to the labour market. Microsoft cutting 9,000 jobs in an effort to limit costs while ramping up AI spending. It's the company's second major wave of layoffs just this year. Sarah Wolfe of Morgan Stanley weighing in ahead of the jobs report later on this morning, writing this: "We think labour demand is slowing, but so far the slowdown is modest. We forecast headline payrolls adding 140,000. Sarah joins us now for more. Sarah, good morning.
Good morning.
So big question, and you've got a little bit of time, so walk us through it. What on earth is happening in this labour market?
Well, we're seeing that there's a mix of indicators. The openings data from JOLTS, hiring, layoffs, that's more or less stabilized and doesn't look that concerning. But there's a broad base of indicators that are showing a more significant deterioration. And I think that's why the Fed is so split on where the economy is going. Are we headed towards a gradual slowdown, or should we be more worried? So if we look at the Challenger data on layoffs, that's more concerning than the JOLTS data. How consumers feel about the labor market is more concerning. Jobless claims data has been rising. I think overall, what we could take from this is that the labor market's cooling off. Part of it is the immigration story that you were talking about. But I don't think we're quite at that point where we're going to see an inflection higher in the unemployment rate. What will drive that into the point with the Microsoft layoffs, once we start getting more of that economic slowdown from tariffs hitting the labor market, pushing companies to do layoffs, we don't have enough hiring happening to reabsorb those workers. And that's where we're going to start to see the inflection higher in the unemployment rate. And we could see another 40 basis points higher to 4.6, 4.7 by the end of the year pretty easily.
Wait, hold on a second. 4.6, 4.7, that would trigger potentially the SOM rule back to where we were last year. Are you saying that you kind of are sympathetic with the idea that maybe the Fed is on the back foot and might be too late?
The Fed's definitely on the back foot. It makes every labor report more and more important as we get into the end of the year, because they're going to have to be patient. They're likely not going to cut in July, because this one print, unless we're somewhere between zero and negative, is not going to be enough for the Fed to deliver cuts. But if we get something in August ahead of the September meeting that shows a consistent deterioration around the zero range, the Fed's going to start cutting, and they might actually feel like they need to come with bigger cuts than 25 basis points. One of the things Chair Powell said is that we would have been cutting if it wasn't for tariffs, which basically means they're ready to cut interest rates. And so if they're coming later, they might be coming larger.
How much of this story is AI? We've been flirting with that for quite a while, and the idea of Microsoft continuing to do their layoffs. They had an 18,000 person layoff, now a 9,000 person layoff. We saw this with Meta, the year of efficiency, which has led to the year of big gains and $100 million bonuses. But I'm just curious, is this sort of the path forward?
I think a lot of actually what we're seeing broadly for hiring right now is AI might actually be supporting some of the hiring, because you need all these data scientists and resources to build out the AI infrastructure. Once we really start to reap broad AI productivity gains, that's where I think we're going to see more of that ripple down effect into layoffs or weaker hiring. So we're seeing it a bit in small pockets in the tech sector, but I don't think AI is the story right now. I think the fact is the economy is growing in the first half of the year by 1%. Immigration has slowed down, so break-even payrolls have gone from 200,000 last year to about 100,000 now. And so all of that, I think, is what's going to be showing up in the data right now.
Have you seen any differences between goods sector hiring and service sector hiring over the past few months?
Well, we're seeing the services sector start to cool off. Most of job gains were coming from education, healthcare, government-related jobs. That was actually driving 2/3 of job growth over the last few years. And now that has started to deteriorate, which means we need other sectors to step up if we don't want to get negative prints. So we need the CapEx side of the economy to start to accelerate, so investment-related jobs to pick up. We need manufacturing and construction to start to come back. We're seeing cracks in the housing market that's weighing on construction hiring. We're getting early signs that onshoring is happening, but it's not providing a meaningful boost to manufacturing employment quite yet.
Nothing you've said in the last 5 minutes could be summarized as solid. Why is the chairman calling this solid?
I think he's trying to keep optionality and have a calm head, right? He's trying to guide the economy through very turbulent, volatile times when you have very different communication coming out of the White House versus the Federal Reserve. And then if you also think about the views among the FOMC, their views are so dispersed that the best thing to be is calm and remain optionality. If you look at rates pricing right now, it's about 25% for July, 90% for September, then you're between 60 to 70% for October and December. It's a good place for the Fed to be. It allows them to cut at basically any meeting through the end of the year without disrupting markets. And so his communication has clearly been effective at setting them up that way.
So just to present a counterfactual, and just to let's go into the realm of hypotheticals, if this Fed were to cut by 100 basis points, hey, how about 300 basis points? What would happen to inflation? Would that really cause inflation expectations to materially rise, given the backdrop that you just portrayed?
I think if you look at the services side of the economy, which is actually offsetting, which is pushing down inflation right now and will likely offset some of the tariff effect, that's going to continue to moderate, I think, even as the Fed is cutting interest rates. Because if you look at all the forward-looking indicators, in particular for the housing market, so shelters, the biggest chunk of services inflation, that's trending lower and coming sustainably lower. And I don't think interest rate cuts are really going to change that. So I do think that we're in a good place for the Fed to cut in a couple of months from now, because as long as tariffs are transitory, the underlying trend should come down, and growth is so weak that the Fed needs to deliver a little bit of stimulus.
Sarah Wolfe of Morgan Stanley. Sarah, good to see you.
Good
Thanks
to
for
see you.
dropping by. Looking ahead to payrolls, not too far away, 8:30 Eastern Time. The estimate 106K in our survey. With an update on stories elsewhere with your Bloomberg brief, let's cross back over to Danny Berger. Hey, Danny.
Hey, John. We are still monitoring the House of Representatives, which is on track to pass President Trump's one big, beautiful bill this morning. Voting is expected to start after Minority Leader Hakeem Jeffries, who you can see there, speaking live on the floor. We don't know when that will happen, as he is permitted to speak as long as he wants, and he's already been going on for 2.5 hours. We'll bring you any developments as they happen throughout the morning. Elsewhere, President Trump announced a trade deal with Vietnam. It includes a 20% tariff on Vietnamese exports to the U.S. and a 40% levy on goods deemed to be transshipped through the country. In return, Trump said Vietnam agreed to drop all levies on U.S. imports following weeks of intense diplomacy. And in sports, the second round of Wimbledon is underway after an upset-filled first round. American Frances Tiafoe lost to Cameron Norrie, while Taylor Fritz won in a 5-set thriller. Jannik Sinner and Novak Djokovic both take the center court later today. And in the women's tournament, number one Aryna Sabalenka survived a close first set to move on to the next round. And that's your brief, John.
Danny, thank you. Appreciate it. More from Danny in about 30 minutes. Up next on the program, the pressure building for a rate cut.
The consensus view among almost everybody was that tariffs would start to impact the data in March. It didn't happen in March, it didn't happen in April, it didn't happen in May. There's no question the inflation news has been much better than anybody thought. So the income trends are great. The unemployment rate's going to stay low.
We'll see about that at 8:30 Eastern Time. We'll get a view from Mike Collins of PGIM up next. Equities a little bit firmer here by not even 0.1% on the S&P, and the Nasdaq 100, a similar move. On Russell doing better, small caps up by 0.8%. In the bond market, 10-year bond yields grinding lower for a fourth consecutive week. If we close out at that level, a fourth consecutive week, the longest such streak going back to February of this year. We've had a real pullback at the long end. The focus on the front end at the moment, the 2-year 376.21, yields are down 2 basis points on the session, and once again, the Treasury Secretary Scott Bessent making an argument I've heard him make before, comparing that 2-year to where Fed funds is, Fed funds, by the way, 425 to 450, and making the argument that that 2-year is telling you the overnight rate is too high.
Yeah, by something of the tune of 75 basis points, that the Fed could cut rates by 3 times without necessarily causing a disruption to markets. That's an argument he's made before. Whether Jay Powell adheres to that, he has not. He doesn't adhere to this at all. And he says that the market is looking at one thing and they're looking at something else, and that's the reason why they are data dependent.
Priya Misra put it well. Really, the 2-year is reflecting a Fed dot, which shows you rate cuts anyway over the next 18 months.
I mean, this is the big issue that I have. Are we talking about the same thing with different political overtones? Are we talking about a Fed that is poised to cut 2 times, regardless, later this year? And then, this argument in both the economic sphere as well as the political sphere, you need to cut by 2 or 3 times later this year, which is essentially exactly what they are planning to do.
We'll see if it starts in September. Under surveillance this morning, pressure building for a rate cut.
The consensus view among almost everybody was that tariffs would start to impact the data in March. It didn't happen in March, it didn't happen in April, it didn't happen in May. There's no question the inflation news has been much better than anybody thought, and tariffs are not inflationary. So the income trends are great. The unemployment rate's going to stay low. You're going to see the labor markets tighten and growth accelerate in the second half of the year.
It's the latest this morning. President Donald Trump amplifying his pressure campaign against Fed Chair Jay Powell, writing on Truth Social, too late, should resign immediately. Michael Collins of PGIM Fixed Income writing the Fed's hands are tied for now, but we still think a Fed funds rate cut or 2 are likely by year end. Michael joins us now for more. Mike, welcome to the programme, sir. Let's talk about these rate cuts. Are they cutting interest rates of the Federal Reserve later this year, in your mind, because inflation is coming down or because this labour market is going to start cracking?
Both, actually. We've been in the camp, Jonathan, as you know, that the Fed is really stuck, right? They're going to keep the rate where it is until things change, either in terms of a labor market weakening or this tariff-induced inflation not being as bad as feared and maybe being just a one-off and seeing inflation really stay kind of in the low 2s here. And I think in both cases, the data are moving in the right direction, right? They are really supporting the case for a rate cut or 2 by the end of this year, which, as you've been talking about, is fully priced in.
Mike, do you care about this report that we get in 40 minutes' time?
I really think that people are talking about what is the run rate, what is the steady state level of job gains each month. And, maybe it was, we were running at 400, then 200, then 100. It feels like because of the natural slowing in the job market cyclically, but also the net immigration effect, it feels like that natural steady state of job growth, Lisa, is below 100 now. Who knows? Maybe it's 0, maybe it's 50,000. So I think you're naturally going to see a lower prints on these monthly job gains. And I don't know if it should spook the market. The linchpin is that unemployment rate, right? You could still have a fully employed labor market with slowing job gains. And I think that's really the conundrum the Fed is going to face. They're going to see these slowing jobs numbers and see the labor market still look fairly tight. The big number today we're looking at really is the wage gains. And obviously the wage gains have been slowing steadily for a couple of years now. And I think we'll continue to see that as companies, they're not necessarily firing people. They're just pulling back on hiring right now. But wage gains are definitely slowing.
If you don't see inflation as being a persistent feature of this U.S. economy, and if you do see tariffs as not as inflationary as people previously believed, why isn't the 30-year, why isn't the 10-year yield a lot lower in the United States?
Yeah, I think they're just pricing in, 5 rate cuts, right, for the next year or year and a half is what's priced in. That seems very reasonable to us, right? If that happens, then you have a kind of a normal upward sloping term structure, right? So that's what's fully priced in, and that seems natural. What is not priced in, Lisa, is the downside tail risk, right? What is not priced in the credit markets, in the equity markets, in the vol markets, and arguably, to your point, in long-term rates is a nastier downside surprise where, Trump does get his way and the funds rate doesn't go down 100 basis points it goes down 200 or 300, right? And that is a very different world. That is not what we're expecting. But again, the markets are assigning a really low probability to that, and probably too low.
Mike, just to pick up on that, let's just focus on risk assets. Let's talk about equities and, say, high-yield bonds. High-yield credit, of course, you're very familiar with. You know it well. Credit spreads right now, 280 on high-yield spreads and grinding even tighter. And what's interesting about that, if you take the Economic Surprise Index, something else you know well, but for our audience who might not be familiar, just where is the data coming in relative to expectations? That's been rolling over since November. It's had a smallest bounce, but ultimately the trend over the last 6 months, not great. So the surprise index has been rolling over, the equity market's been going higher, and credit spreads have been grinding tighter. How do you explain that? Either we're whistling past the graveyard or the data is just becoming less and less relevant. Which one is it?
Yeah, I think it's the whistling past the graveyard for sure. I know, Lisa, it's good to see her fired up this morning about this. And, the financial conditions is something that, not a lot of people are talking about, right? Yeah, could the Fed cut 100 basis points now? Possibly. Maybe that's the right level to be at, frankly. But, what would happen to financial conditions, right? Would the stock market go up another 10 or 20%? Would credit spreads continue to grind in? And that brings in a whole host of other risks to the upside of the economy and the upside of inflation, right? This economy has been driven by the upper end of the wealth and income spectrum, which has been driven by this paper wealth effect, right? And I don't think you want to add fuel to that fire. And I really believe that's one of the reasons the Fed is really hesitant to cut here, because they don't want to add fuel to that fire.
If you think people are whistling past the graveyard, Mike, what's your highest conviction call right now?
The conviction is that, growth is going to moderate a little bit, and recession risk really does look low, right? I mean, the big theme we've been focused on, Lisa, throughout this whole cycle is, where are the tipping points in the private sector? The public sector is a mess. The fiscal situation globally is a mess. But, typically these recessions happen, these downside risks happen when you have an over-levered housing sector or financial sector or corporate sector or consumer sector or mortgage sector, and you are not there this cycle. We have not had a re-leveraging of the private sector. Yeah, there are some pockets in lower-end consumers where you're seeing bigger increases in debt and leverage, and you're seeing a big increase in personal bankruptcies and small business bankruptcies, which is certainly worrisome, but it's not systemic enough to take the whole economy down with it, right? So we have a pretty strong conviction that it's going to be a slowdown in the economy, but this kind of cataclysmic, credit risk off, credit crisis is a really low probability. And that's frankly what the markets are running with and pricing in.
Mike Collins, appreciate your time, sir. Mike Collins there of PGIM Fixed Income. Just different ways to think about this market at the moment. Some people just think the data is becoming less relevant for a bunch of reasons, including the fact that we will get clarity on some big policy issues, and maybe the data starts to improve as the year goes on.
Yeah, well, how many times can you get a head fake before you start to feel like, well, what does anything matter anymore?
Go to the beach, apparently, for the 5th time already this morning. Not yet. Payrolls 34 minutes away. Nadia Lovell of UBS, Becky Frankiewicz of ManpowerGroup, Jeff Rosenberg of BlackRock, Torsten Slok of Apollo, and a whole lot more still to come.
Most likely, we see a slowdown in payroll growth. Over the next couple months, we see this gradual slowdown.
The data is going to weaken. The growth rate is going to fall. The unemployment rate is going to rise.
If you get a 0.2 rise in the unemployment rate, the market is going to respond quite negatively to that.
Labor demand has cooled significantly, but we're not seeing mass firing.
If we see a sub 100,000 job and certainly a negative jobs number, that would start to create the narrative of weak, hard data that would allow the Fed to cut rates.
This is Bloomberg Surveillance with Jonathan Ferro, Lisa Abramowicz, and Annmarie Hordern.
Live from New York City this morning. Good morning. The third hour of Bloomberg Surveillance starts right now, tracking live pictures down in the nation's capital in Washington, D.C. The House Minority Leader, Hakeem Jeffries, speaking for 3 hours. 3 hours. As the House gets closer and closer towards a final vote on the one big, beautiful bill. Once we've done that, we can move on. From taxes to trade, July 9th, the next stop for this market. Before we get there, it's about 29 minutes away. It's payrolls Thursday, and the estimate in our survey, 106K. The previous number, 139. Your equity market this morning positive by 0.1%.
Yeah, and not to make this existential Thursday, but the big question is, what do these numbers mean, and how bad could the number be before it is bad, and how good could the number be before it is good? Citigroup's Andrew Hollenhorst just put out a note, and this to me is really the ultimate question. How bad does the number have to be, or what does it look like in order to get the Fed to put July as a live meeting where potentially they could cut rates? They said that what that could do would be a 4.5% unemployment or negative payrolls. That could potentially push them to cut rates as soon as July. A 4.4% unemployment rate wouldn't quite be enough, but would set up the rest of the year.
You're right to define what's bad, and I'm totally with you. You can't just do it with a headline number. If we get, say, 80, might get 150. I don't know what the number's going to be, but let's say we get 80 at 8:30 Eastern time. There'll be economists sitting around this table saying 80 is not bad, immigration's come down, this is probably the run rate of the labour market right now. Check unemployment. You can't define this jobs report this morning without checking unemployment. If unemployment is going up and jobs growth is slowing, the pressure on this Fed to cut is going to build big time.
Yeah, if you start to end up with both a low jobs number and a sense that it's not just because the labor supply is contracting to such a degree, that will present more of a problem. Ultimately, people are wondering, what do we do with these numbers that are getting skewed by both secular and cyclical trends? And that is a very difficult moment to really encapsulate. And that's the reason why we're talking about AI, we're talking about immigration, we're talking about a whole host of other metrics, in addition to how is the economy doing? The
AI question, I think, is still the most important question for a lot of people. Are service sector companies reluctant to make full-time hires because they're investing a lot in AI? Are we going to see much more of that? And you've been on top of this story now for weeks. If you're a graduate coming into this economy, it's getting harder and harder to get a job. Why? Is it about the economy, or is it about AI?
The spread between the unemployment rate for recent college graduates and the overall population is about as wide as it's ever been. It's almost a record differential. That is how difficult it is for people to get jobs. It raises a question, is this AI, or is this because this is a stagnant labor market that doesn't have the give, the forgiveness that allows people to move on and have other options? And that has been the hallmark of American capitalism. There are a lot of big questions here, which is the reason why some people are checking out and some people are checking in and say, look at the details, and then you'll get maybe some of the answers.
The jobs report is just around the corner, 8:30 Eastern time. Coming up this hour, we'll catch up with Nadia Lovell of UBS, following another record high for the S&P 500. Becky Frankiewicz of the ManpowerGroup on the so-called rebalancing in the labour market, and Torsten Slok of Apollo reacting to this morning's payrolls report. He's looking for higher unemployment in the months to come. We'll begin this hour with stock steady, ahead of jobs data out in just under 30 minutes' time. Nadia Lovell of UBS writing, we believe the bull market remains intact. We would use pullbacks as opportunities to phase in to equities. Nadia joins us now for more. Nadia, good morning.
Good morning.
It's good to see you. Last time we spoke, you went neutral equities. Is that still the position, and why?
That is still the position. I mean, when you look at where the market is today and how much it has rallied back, it feels like a lot of optimism has been priced in the market. Like, of course, the economy has remained resilient. And some of that, you can argue, maybe it's some front running ahead of tariffs. But we do expect a soft patch later this year, and the market will have to reconcile that. Now, John, that does not to say that we think, again, that the bull market is over. We think that this market can continue to see some gains, modest gains from here, however. And we think that there's still some uncertainty around tariffs that has to be reconciled. And so we are doing stuff. We're just doing things from a relative standpoint. We've been advising our clients to stay fully invested in our mandate portfolios. We're doing more relative value trades, so really, preferring U.S. and EM over Europe.
We often say you can learn something from the data and you can learn something from how the market responds to the data. So yesterday's data was a tariff on Vietnam. It was 20%. Yeah. This market rallied. Nike and other stocks, Lisa and I have been talking about it all morning, we're up and to the right. 20%, not 46%. The bar seems to be really low going into July 9th. Is that how you look at things?
I don't think that the bar is that low going into July 9th. Is Vietnam a template, right? I think most of the market is sort of pricing in tariffs to stay around, effective tariff rate to stay around 15%. And so if you start to see more of these 20% tariffs and still you have sectorial tariffs to come, that is going to challenge that narrative, right? And ultimately, we do think that by the end of the year, we're still in the same place. But in the short term, we could see some volatility. It isn't clear what we should expect on July 9th. We're hearing different things from the administration. Bassett is saying one thing, the president is saying a whole other thing. So we do expect to see some deals, at least in principle. And then after that, we do think that you could see a bit of a escalation again in some of the trade tension, particularly some of our largest trading partners. We still have EU to go.
How much is that offset by what's getting done in the House today? And I'm not just talking about Hakeem Jeffries, who has been in a 3-hour role, but just getting through a bill that is front-loaded and is going to be stimulative, in particular to businesses.
Yeah, but I think some of that is already priced into the market. Yes, it will potentially be stimulative early next year or even towards the end of the year. So we do think that some of that is additive. But again, it's not going to offset the full potential headwind and so then that you could get from, if tariffs reaccelerate again.
John was saying that you can learn something from the data and you can learn something from the market's reaction to it. And you could see that with respect to the tariffs, but you can also see that with respect to payrolls. And we've been trying to understand, Mike Collins talking about whistling past the graveyard. Are people looking past weakness to their peril? What kind of number do you think the stock market would wake up to and say, wait a second, maybe this isn't quite the sort of benign backdrop that we've been looking at?
Lisa, I know you're going to like this one. It's not just about the headline. We also have to look at the revisions, right? Because, gosh, haven't we seen a massive amount of downward revisions? And so while the headline numbers can cause some knee-jerk reaction, I think you have to just peel back the onion.
We're peeling as quickly as we possibly can. Carry on.
The equity market has weird reactions on payrolls, as we know, and that doesn't necessarily transpire for the rest of the trading session into next week. And so I think if you see something, under 100K and, massive downward revisions from prior months, we've been running at 40 to 50K downward revision. So is that 100K really more 60K? And so I think that's going to give the market some pause. So if you see something like 80, that probably means that the labor market is weakening faster than people expected. And that could accelerate cuts from the Fed. But again, we'll see where it comes out.
Already pricing in those cuts in the bond market. And I think increasingly equity investors are as well. We've heard from a range of guests in the past week that they're willing to look through weakness because ultimately it would introduce rate cuts from the Federal Reserve. And I've heard less thoughts on July 4th, July 9th, taxes and trade, and more thoughts on 26. It just feels like a lot of market participants have moved beyond 25 and they're focused on earnings growth next year and beyond. Is it too early to do that?
It is a little bit too early to fully look on 2026 because the next 6 months is going to matter as well and how sort of things progress into 2026. Reality is if we see an acceleration in terms of unemployment rate, if the Fed doesn't come to the rescue fast enough, if tariffs reaccelerate, we could end up in not even a soft patch or something even worse in terms of a recession. And so eventually you can get recovery in 2026, but the path to that can be a much choppier path than, say, sort of a market that goes straight up and to the right.
I'll make it really simple. At 8:30, is bad news good news or just bad news?
I think, again, it always goes back on how bad that news is, right? Yes, there will be parts of the market, if you see a weak payroll numbers, will get excited that the Fed will be looking to cut. But I think by the time you get to next week, particularly when you still have the uncertainty around tariffs and those rates, you could see the market start to take a breather again.
Nice try. That's all I could say.
It was an attempt.
I know that was good, but this is the difficulty. You say, so is bad news good news? Is good news bad news? Other than Stuart Kaiser, who looks at me with disappointment. Everyone else says, let's get back to that onion and keep peeling it back.
You can feel the bias, though, can't you? The bias is sort of downside risk into this payrolls report. I think we do have to sort of introduce another question. What happens if it's good? What happens if it's actually pretty decent at 8:30?
I know. I've actually wondered this. Have we really accounted for a potential upside surprise? And then is that bad news for the Fed? I guess the bigger question is how much and at what point can Fed cuts offset any potential weakening in the economy for risk assets, right? I mean, essentially, if people are betting that some Fed cuts, even with weakening, is a good thing for risk assets, then can we absorb bad news more easily than maybe an overheating economy into potentially tariff-driven inflation?
Nadia, thanks for indulging us or tolerating us. We appreciate it. Nadia Lovell there of UBS. Neutral on equities this morning. Equity futures positive by about 0.1% on the S&P. With the latest news elsewhere, some of our top stories in our Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John. One of the top stories continues to be President Trump's one big, beautiful bill. It is on its way to the final vote in the House. Republicans cleared a procedural hurdle to advance the tax and spending bill early this morning. Debate is underway.
underway, as is the Magic Minute from Representative Hakeem Jeffries. But that sets up a vote for later this morning ahead of Trump's self-imposed July 4th deadline. And we'll bring you any of those developments as they occur throughout the morning. Elsewhere, President Trump says Federal Reserve Chair Jay Powell should resign immediately. This after the head of the Federal Housing Finance Agency called on Congress to investigate Powell, alleging his recent testimony to the Senate about the central bank's planned renovations to its headquarters was deceptive. Elsewhere, Lululemon is suing Costco. It accused the wholesale retailer of copying its apparel designs. The disputed products include hoodies, jackets, and pants that allegedly replicate Lululemon's designs and trademark silhouettes. Costco has not yet filed a response to the lawsuit. And that's your brief, John.
Danny, thank you. Now we know where to go. Didn't know before.
I mean, come on. Unless people really care about the little, like, hair. Is that what that is? Like a women's hair?
I've got no idea what that is.
You know,
the logo.
Sort of,
I know what you're talking about.
Yeah.
Is that what it's meant to be?
I'm not sure, but I'm just
Okay.
trying to imagine what that could possibly be. But I'm like thinking, how much is that dancing thing?
Yeah, right?
Yeah,
like, this is a great commercial for Costco. Anyway.
Not sure
right.
that was the intention.
No. Danny, thank you. Up next on the programme, the Morning Calls, plus Becky Frankiewicz of the ManpowerGroup as we count you down to the payrolls report. The payrolls report about 18 minutes away. Vacation begins in 16 minutes' time, 1 minute after we get a payrolls report at 8:30 Eastern Time. Equity futures into it. Your scores look like this. Positive 0.1% on the S&P at all-time highs coming into Thursday morning. On the Nasdaq 100, up another 0.08%. Let's get you some morning calls. First up, Needham upgrading Meta to hold, seeing upside to estimates and strong labour productivity. That stock is up by 0.75%. Your second call from Goldman, raising its price target on Tesla to $315, pointing to better than feared Q2 vehicle deliveries. That stock is up by 0.4%. And finally, BNP Paribas Exane upgrading FedEx to outperform, saying the stock is arguably oversold. The stock is up in a pre-market by 1.4%. That's some of the calls this morning. Let's turn back to the labour market. Investors counting down to payrolls. ManpowerGroup President and Chief Strategy Officer Becky Frankiewicz seeing a rebalancing, writing after several years where job seekers held the upper hand, the balance of power is starting to tilt back towards employers. Becky joins us now for more. Becky, welcome to the programme. Off the top, I just want to talk about the service sector. I want to understand your experience at the moment. Are you seeing service sector providers reluctant to make full-time hires and moving towards temporary workers because of what's happening with technological developments?
Yeah, so I'd say two things. We're not seeing a lot of movement anywhere. So when you say, are we seeing big shifts? We're really not seeing that. We're starting to see some impact from AI. That is happening. We're seeing increase in hiring around statisticians, people who can model data, and the big hirers in that space are the Accentures of the world, Microsoft, et cetera. We are also seeing on the other end of the spectrum of the labor market, summer hiring start to pick up, really from frontline supervisors in food service preparation, and a big surge in our retail workers, both online and offline, as consumers shop in both forms. So the labor market is slowing. That power pendulum is shifting towards employers, but there are a couple of bright spots. But make no mistake, it is a slowing, very strained labor market in the United States.
Becky, you touched on another theme and why it's so difficult to read right now. It's not just technology or the broader economy, it's also immigration. Becky, are you seeing certain sectors that would typically depend on immigration looking to hire more aggressively elsewhere, domestically here in the United States of America, and finding it difficult to get the talent?
Yeah, so we are definitely in a talent shortage. There's no question around that, both in talent supply and also skilled talent. That is happening. It's ironic, though, John, as you would think we'd see a big surge in our new graduate hires. But it is a tough time to be a new college graduate in the U.S., where unemployment among new graduates is 6%, juxtaposed to 4% for the broader economy. So you would think if we were looking for new-to-world workers, we'd have lower unemployment among that group, and we're actually not. And so my hypothesis is employers just aren't hiring. They're not hiring entry-level, anticipating AI to take some of those roles. They're looking for more experienced hires when they're hiring. And for those summer jobs, those transition jobs, they're going to those high school students for summer employment.
So, Becky, can we build on this? Because this is something that we've been discussing for a long time. Is this the new normal where it will be a lot harder to break into the workforce, particularly for white-collar jobs in the technology, in the banking sphere, because of AI taking on a lot of the roles that entry-level workers typically did?
Yeah, Lisa, what is entry level? You know, in the future, what is entry level? I mean, I personally learned how to work by calling on retail stores. The job that I started and learned how to, communicate with others, sell, that job won't be here in 3 years. And so it is still here today, though. AI is starting to impact, but it's impacting in the data structures versus in actually taking those frontline jobs. However, we can't anticipate that's going to happen. So this idea of how do you get work ready, it is going to change. You won't come in and do the tasks, the repetitive tasks. You'll have to come in and be ready to contribute at a different level. And that is why I believe that we're seeing this higher unemployment among these new college graduates.
So, and we could talk about AI and the way it's going to transform the market, and I'd love to do that at another time. If you put this through to job creation, does that mean that we are headed toward a lower job creation environment for a long period of time, that we're moving more to a more European model in a way, where there's lower firing and lower hiring, and that's just the way it is?
Yeah, I don't know if we're moving to a more European model structurally, but I think what we are seeing, and it may surprise you, that jobs that are resilient or durable are manufacturing jobs, production operators, supervisors. Again, even right now where we're seeing decreased in demand, where is the hiring happening? It's happening in medical and health, registered nurses, retail supervisors. So there are still durable jobs out there in our current economy. In terms of the future and what that looks like, the belief continues to be that there'll be new jobs created, software developers, which we've seen be impacted, that job's being reshaped now. There's new titles, AI ethicist, two words I would have never put together. So there are being new jobs created, but we're in a bit of a holding pattern as people wait for the new normal to set in. They're holding.
That speaks to the low churn of the moment. Becky, appreciate your time as always. Becky Frankiewicz there of the ManpowerGroup. Becky's great at breaking this down. Just really helping us understand how complex this labour market is right now. There are shortages in some places, demand issues in others, and within the demand issues, there's a whole bunch of reasons for it, not just the broader economy, trade, tariffs, whatever, policy volatility, uncertainty, all of that, but also technology. We keep going back to AI.
And it goes to something you've talked about, which is where will the jobs recession be? It will be the white-collar jobs recession. You're talking about technology and the financial sector, and that's where the unemployment rate, particularly for new graduates, has gone up dramatically. Where are the jobs? Manufacturing. It's in the services sector. It's in the healthcare. It's in some of these other areas that are harder to really replace with quantitative computing in the same kind of way.
What's it going to do? Replace us or enhance the jobs we already have? First of all, it's going to slow down hiring, at least in certain places, until we have a full understanding of what this actually means. Does that speak to the difficulty that graduates are having right now? Because that's a major problem, both for the economy and politically. If you don't like what you're seeing politically in certain cities, if you don't like that, they're going to vote a certain way.
Well, yeah, if you've got an entire group of people who are being locked out of a labor market, they might be more inclined for a different type of economic structure for, say, a municipality, and which could play into it. I mean, I don't want to get into this kind of political argument. There is, though, this complication of how you understand this evolution. And if you either have to be incredibly highly skilled and incredibly good at critical thinking on one side to be very wealthy, or you're manufacturing and working as a nurse. I mean, these are the bifurcations right now that people are trying to extrapolate out.
We've got the rest of this year to talk about politics in New York City, haven't we?
Yay.
So let's move on. The jobs report's 8 minutes away. Mike McKee's dropping by to help us understand what to look for. Mike, it's a different jobs report. There's a different feel to things going into this. What are you looking for?
Well, everybody's looking for a slowdown in job creation, and I'll certainly have to check the TV anchor hiring to see if you guys have a future. But we're looking for only 106,000 jobs created during the month of June. The whisper number, 95, 96. So basically, Wall Street leaning to the idea that we're going to get a disappointing report. Now, what is disappointing to the Fed? They're going to be looking at the unemployment rate because that's their signal for whether the economy is slowing. And we're going to have to go out to 3 digits because it barely cracked 4.2 last time, rounded down. It could easily round up this time to perhaps 4.4, depending on where we come in. We also have a lot of other numbers today. Jobless claims, 241, leaves us in the same range that we have been in. Continuing claims, still kind of the same range, but expected to go higher. So we'll see what that works out to be. And then we've got 10 o'clock numbers, too. Trade balance out at 8:30, expected to be bigger, perhaps, than what we saw last month. ISM services, maybe a slight rise, but it's prices paid that'll matter there because the jobs part of ISM services will be already behind us. And capital goods orders not expected to change at all. But a lot of data for people to trade on today. And so we're going to be watching to see if it gives us any signal for how fast the Fed is going to have to move. Not whether they will move, but how fast.
Yeah, Mike, just on that, on the Federal Reserve, how bad would this number need to be just to make that July meeting a little bit more of a live meeting?
Well, I think if you got close to 4.5 on unemployment, then it would put it on Wall Street's agenda, might put it on the Fed's agenda. But I think the Fed is going to try to avoid July at all costs because even if we get a tariff impact in June, it's just the first month of that we would be seeing. And they'd like to have 2-3 months before they actually know that a trend is in place.
Michael McKee, I'm taking you down with me. Appreciate your time. Mike's going to be back with us in about 6 minutes' time to break down the jobs report. Not just tracking that, the labour market report is, of course, just around the corner. Also tracking events down in Washington, D.C. We're told getting closer and closer to a final vote on the one big, beautiful bill. Hakeem Jeffries, the House Minority Leader, is slowing things down a bit. And Lisa, this just in, some breaking news. Jeffries, according to reports that I'm seeing, is now reading from a fresh binder. OK? So you've been tracking the binder and how things are progressing. Apparently, it's a fresh binder now.
Oh, this is a new paradigm. I need to refresh my ideas. What is he reading? Shakespeare? I mean, seriously.
Isn't it Stories of Medicare? Isn't it something like that? Isn't that what he's been doing for the previous 3 hours?
Stories of Medicaid. Yeah. I mean, what kinds of stories? Once upon a time.
I've got no idea. Yeah, they needed. Yeah.
Evidently, you need to pay attention. We will watch that, or we will not be watching that, but we'll be watching the binders and how many there might be.
We'll have someone else to track that. Okay?
Thank you. I think that's good. One thing that I am watching is the market expectation for Fed cuts. Right now, we've got a 23% chance of a July rate cut, which is actually pretty significant. You've got a 96% chance baked into markets right now of a September rate cut as people really look to this Fed potentially moving. You asked the right question. How high is the bar for the Fed to move in July? That's been a moving target.
The jobs report is 5 minutes away. The estimate in our survey, 106K. The previous number, 139. A lot of focus on the unemployment rate. We'll get the numbers in just a moment. The payrolls report is just around the corner. Stephanie Roth of Wolfe Research joins us in a moment, alongside Jeff Rosenberg of BlackRock, Torsten Slok of Apollo. Your labour market data up next. The jobs number just seconds away. The payrolls report about 20 seconds out. Going into it, your scores look like this. Equity futures on the S&P positive by 1/10% as we come into Thursday at all-time highs. On the Nasdaq 100 up by 0.1. On the Russell, the small caps up by 0.8%. In the bond market, 2-year, 10-year, 30-year yields down. Into the print, we're down by 2 basis points. The 10-year 425.73. With your jobs number this morning is Mike McKee. Good morning, Mike.
Good morning, John. A lot of numbers to go through here. 147,000 jobs created, according to the Bureau of Labor Statistics, which is above the 106 estimate that we got from Bloomberg Economics and the economists we survey. Private payrolls up 74,000. Let's take a look here at the unemployment rate. It falls to 4.1%. There was some thought it was going to go maybe as high as 4.4. The forecast was for 4.3. So much better number than anticipated. We also see, and I'm going to jump here to jobless claims, a big drop in jobless claims to 233 from previously reported 237. So jobless claims and unemployment go down, and it looks at this point like it's status quo in the labor market. Labor force participation, 62.3%. Average hourly earnings, they come in low, up 0.2%, pushes the average for the year down to 3.7% from 3.9. Weekly hours, 34.2. The revisions to payrolls 147. The revision is a net of 16,000 additional jobs, so not much change there. Trade balance comes in at $71.5 billion. The forecast was for 71, so that is actually pretty close to right on. Won't make much difference in people's second quarter GDP guesses at this point. And then back to claims, 233, and the continuing claims number comes in at 1,964,000. That is the same as the revised number for the prior week. So at this point, this looks like a very status quo labor report. We got to look under the hood to see what categories moved, and I'll do that while you guys are checking out the market reaction.
Mike McKee, thank you. You can take a guess. The sound in the last couple of minutes, the door slamming shut on a July rate cut. Look at this move at the front end of the curve, up 12 basis points on a two-year yield, 389.86. In the FX market, what happens when you start to see yields go up like that? Dollar stronger, euro dollar rolling over. So some dollar strength, some higher bond yields. The equity market, I'm not sure, doesn't know what to do with this right now. Equity futures positive by about 1/3 of 1%. But good news is good news, and this is good news, much better than expected. An upside surprise on headline payrolls, 147, the estimate 106. The unemployment rate was at 4.2. In our survey, economists were looking for that to climb up to 4.3. It comes in at 4.1. And if you want some high-frequency data, or at least some higher-frequency data, jobless claims, much lower than expected. Across the board here in the labour market, this is a pretty solid read.
You really can't find many cracks here. Even the revisions. I mean, we were talking to Nadia Lovell earlier about the potential for downsides revisions. They were revised up from 135,000 to 141,000. When you look at, okay, does this mean that it's inflationary? No, it doesn't. Hourly rate for earnings actually went lower, came in lower than people expected. So what does this mean for the Fed? What does this mean for exactly what this labor picture is doing right now? It seems like good news is good news, and the bond market is trying to reassess.
Shout out to Mike Gapen over at Morgan Stanley. Had an estimate of 140 going into this particular print, so not bad, eh?
No, I would say that you nailed it, and right now you went against the grain. Congratulations.
Well, then Mike would acknowledge it's sort of like blindfold and dartboards and all that stuff every single month, but let's be pretty clear about this. Coming into this print, a lot of people thought there was some real downside risk going into this jobs report, and we might get a much lower number, particularly after what we saw in ADP, and there's no sign of that in NFP whatsoever.
I think that your conclusion is the absolute correct one. This absolutely slams the door shut on any kind of July rate cut, and you are certainly seeing that getting priced into the market. What this means beyond that remains to be seen, whether this can actually be something we can draw a conclusion from, or whether this is going to be a confusing jumble of numbers that Mike could try to extrapolate apart. And I'm very curious about those TV news anchors that you were talking about, Mike.
Still got a job, Mike, I hope. Looks like hiring. We'll head back to Mike in just a moment. With us around the table, Stephanie Roth of Wolfe Research. Stephanie, good morning.
Good morning.
Your first take on this one.
Yeah, I mean, this is something that we were kind of warning people about, an environment where the steady state pace of hiring comes down pretty substantially and the unemployment rate starts to fall. Because we're in an environment where there's a significant detraction from a foreign-born population, and that puts downward pressure on the unemployment rate. It reduces the unemployed people, and at the same time, it lowers the steady state pace of hiring.
So 150, around 150 now, is what 2 years ago? 250? 225?
Granted, like a lot of the job gains was driven by government, so I think we have to take that with a grain of salt. If you look at private payrolls, that was fairly sluggish, and by category, it was kind of slow as well. So the steady state pace of growth has come down. I would look at it from a private perspective in particular first. And then we're in an environment where you're seeing a tightening in parts of the labor market, which is what the signal from the unemployment rate.
What do you make of the fact that we didn't see hourly earnings significantly rise, or rise even as much as people previously expected? It kind of goes to this idea, can we get a decent jobs number without really any kind of inflationary impulse?
I think it was the timing of the survey week. So this is something that's somewhat underappreciated when you're forecasting the payroll gains. It tends to be very sensitive to the timing of the survey week, and this time it was earlier in the month, which doesn't capture the 15th, which then 15th tends to be the time where you get pay raises and that type of thing. So that tends to put downward pressure on the average hourly earnings number. So we were looking for 0.2 for particularly this reason.
Do you think that this calls into the question the need for the Fed to cut in September?
Yeah, in our base case, we have them not cutting, although it's a close call. It certainly reduces the odds. Certainly July is off the table. And now the question is, can they still cut in September? Base cases, they probably don't, but there's a lot more data, and this is just one print among many that we're going to be getting by the time we get to September.
Stephanie Roth is going to stick with us around the table. The jobs number just moments ago, 147,000, higher than expected. The estimate in our survey was 106. The unemployment rate expected to climb to 4.3%, actually dropped to 4.1% from 4.2%. Got a bunch of other data as well because it is Thursday, and it is payrolls Thursday this time around because of the long weekend. So we got jobless claims as well, and claims came in much lower than expected. 233, the estimate was 241. We've got Torsten Slok with us around the table from Apollo. Torsten, I want to come to you a bit earlier than expected because I want your view on this. You were expecting unemployment to start climbing. Unemployment's falling back. What explains that?
I think the key issue here is the immigration factor, as Stephanie is mentioning, that it is very, very important. So Tara Watson and Wendy Edelberg estimates now that we are seeing significant decline in the long-run payroll growth of closer to around 50,000. And the fact that the unemployment rate is going down is something that, of course, is quite surprising. And the fact that we now have so strong payroll growth, even with a decline in the long-run steady state for non-farm payrolls, tells you that this was a fairly strong report, and this is a very strong economy, which argues to your point, which is our view, that the Fed will only cut once this year, simply because rates will stay higher for longer. There is no need, especially not with Powell at the same time saying that he expects a meaningful rise in inflation over the coming months.
Is it fair to say that this was the goal of the Trump administration, that they wanted to get immigration down so that even if you have payrolls growth of 100 to 150K, could actually see the unemployment rate start to fall?
Exactly, because both labor supply is declining when you deport roughly around 1 million people at an annual rate. And at the same time, labor demand may also eventually slow down. But if it doesn't slow down, then the decline in labor supply on its own will exactly create a report like this one, namely where you have a declining unemployment rate. So it is obviously better than the consensus expected, also better than what we had expected. But it tells you very clearly that the labor supply story is playing a very important role here.
At the same time, it also suggests that the economy or the business environment is much more solid than many people expected as well in terms of hiring, in terms of looking for that. And it's coming without the inflationary impulse that some people were worried about. Do you think that that's durable?
Well, and that brings us back to the discussion around what is the effect of the trade war. Are tariffs not going to have an impact? So far, it's remarkable where you have inflation basically still steady and now job growth still relatively strong. So in that sense, there literally is very little sign of the trade war having a macroeconomic impact at this point.
There are going to be people who look at this and say, this might be the last gasp before a real material weakening. We can't trust these numbers. Max Kettner's already gone. What do you say to that?
Well, that's why the next few weeks with the earnings season will become very, very important, because that's when we'll figure out, is the pig coming through the python in terms of the tariffs heading eventually earnings? Because at the end of the day, we are raising about $400 billion in tax revenue at an annual rate at the moment. Total earnings for the S&P is about $2 trillion. So that means that someone needs to pay $400 billion if tax revenue is going up $400 billion. Is it consumers through higher inflation, or is it companies through lower earnings? And we still, with this report, of course, have just not seen that yet. So exactly to your point, Lisa, over the next several weeks, we'll find out in Q2, how did companies actually respond to higher tariffs? Did they respond by passing prices through in the form of higher inflation? We'll find that out also very soon. Or did they also, in this case, turn out to actually lower their earnings and say we're going to eat some of the tariffs? And that becomes the main question for markets now, namely what was actually the response to tariffs in the second quarter?
Mike McKee is back with us for a little bit more. Mike, you've taken a second look at the numbers. What explains the upside surprise?
There's just some hiring in a lot of different categories. You're going to laugh at this. The biggest category for hiring was government. 73,000 additional jobs, but that is almost all in state and local government, a lot of it in state and local education. 7,000 jobs lost in the federal government. Now, maybe we get a lot more once we get to the fall and some of those people who are getting severance finally leave the labor force. To what you guys have been talking about, the interesting thing here is that the number of people who are in the labor force, foreign-born, went up this month. Same is true of the people who are in the labor force who are native-born, although the overall level of the labor force falls by 120,000 people, 130,000 people. So you can see why the unemployment rate went down. 93,000 people went or got employed according to the household survey, and 222,000 lost jobs. but because of the drop in the labor force there, you're seeing a lower unemployment rate. But the labor force doesn't seem to be having been affected by the overall numbers of people who are being deported. Manufacturing lost 7,000 jobs during the month. Construction gained 15,000, more than anticipated. Retail trade only 2,000. Now, if we are seeing a slowing in spending, that might be showing up there. That might be one of the first ones that we see that is a problem. And Lisa, I checked on you, and arts and entertainment hiring was up by 20,000. Nice. I don't know whether you are arts or entertainment, but you would fall in that
Both,
category.
Mike, both.
Yeah.
Arts and entertainment.
Dear
so
Lord.
for right now, you're okay.
All right, thanks. I'm so glad. That was the news you need to know.
Mike McKee, thank you, sir. Looking at bond yields this morning, bond yield higher by 8 or 9 basis points at the front end of the curve off the back of this upside surprise. Once you push that through foreign exchange, you get a stronger dollar. Euro dollar right now negative by about 0.5%, 117.42. Talked about the equity response to that. Not convincing, still positive though by about 0.2%. Talk about the market. Jeff Rosenberg of BlackRock jumps on to talk to us. Jeff, welcome to the program. What on earth did you do with this one this morning?
Jonathan, I haven't heard you say it yet, but, this is a great example of where the first reaction is not necessarily the last reaction. I think we got to rewrite these headlines, everybody. This is about the private payrolls, and private payrolls disappointed to the downside. Mike McKee just talked about it. The upside surprise, it's government, and that may be surprising. Federal government was down. That's not surprising. That's DOGE and the cuts. It's state and local that's very high. If it's education, to me, that sort of sounds like there's a lot of education workers coming back into the job market in June. No, that's a seasonal adjustment effect. So the story here is not the headline. The market is reacting to that. Maybe it's the algos. Let's get the humans back in the room, back into the trading, and look through this report. This is a slowdown and a little bit disappointment on the private payroll side. You look at private services, it's well below 68,000. It's well below the 6-month average. Not like earth-shattering here, but this is the slowing in the job market that we are expecting. The market reaction is trading off of the headline, but I think the story here is much more about private payrolls, and that is actually a very different headline. Now we'll see if the market eventually picks up on that as the end of the day.
Jeff, you're right. I always say it. So let's rewind 15 minutes. The first move is not always the right move. So let's wait and see what happens later in the day. There you go, Jeff. I got it out. Jeff, let's talk about what we're seeing in private payrolls then, and talk about this move in the market. Would you fade what we're seeing? High yields at the front end. Would you fade what we're seeing in the FX market? A stronger dollar?
Yeah, I mean, that's basically my point, is that the initial reaction here may be a bit overstated with regards to repricing. Now, I agree with you. I think July may have been, overstated to begin with. But I think the broader story here is the slowing in the payrolls that we've seen for some time. I think it's actually confirmed by this report. And then I want to reemphasize what Torsten just said, because I couldn't agree more, that it's really going to be about profit margins and what we learn from corporations. I think you used, Torsten, the pig and the python. That's exactly it. I mean, we're still waiting for the impact to show up. It's been showing up, and the other story around payrolls is they've been overstated, and so the big question is there an underlying weakening here that is a little bit greater than what is anticipated? I think the story here today of headline versus privates is kind of throwing more confusion in there. The revisions were a surprise to the upside. People looking for the revision story to show up, so that was a little bit stronger than expected. But I think it's really going to be about the corporate reaction here. And it's been, as we saw in the JOLTS data, it's been a pretty stagnant, very, benign kind of layoff environment. We have to see whether or not that is maintained.
But Jeff, isn't this kind of conducive to risk assets? And I say this at a time when you have a potentially stimulative bill coming out of Washington, D.C., albeit increasing the deficit. But you have sort of steady, if slowing, growth at the same time that you have a Fed that is poised to cut rates in September and potentially again later this year. Isn't that potentially still okay for everything to continue on the status quo?
Well, yes, in some sense that's the case, but it's already well into the price. So you look at like the performance of cyclicals versus defensives, for example. You're seeing expansionary type moves in the face of that. You said slowing but steady. I'd emphasize more the slowing. Most of the economic data is slowing, and that's what the payroll data here is validating. Now, it's not the end of the world, and it's not saying the sky is falling or there's recession, but this is consistent with a mid-cycle slowdown. So there's a little bit of a disconnect between kind of what we're seeing in valuations and what we're seeing in terms of the slowdown. And that doesn't necessarily, mean you jump in with both feet and everything's sky is clear. You got to take a little bit of caution with respect to what's in the price versus what we're seeing in terms of the macro backdrop.
Hey, Jeff, appreciate it. Jeff Rosenberg there of BlackRock. The message you sent earlier on about 2 hours ago.
Which one?
Which is basically the data and the market are on two different pages.
Well, exactly, and this is partly because the market right now is looking to AI, is looking to different advancements, is looking to good enough, and the economy is looking at a very different backdrop where you have very low hiring and very low firing, and that at some point you have to have a meeting of the two.
Stephanie, you heard Jeff there, the distinction, headline payrolls versus private payrolls. You talked about it briefly as well. Two different stories.
Kind of to some extent. The government, the strength in government specifically tied to education was probably a seasonal quirk. Totally agree with that. The fact that private payrolls are in the 70s shouldn't be that alarming, though, because we know that the steady state pace of payrolls growth has come down. We should be concerned if it was stronger than that, because we don't have the labor force to support it. That if it was running notably above 100,000, you're going to start running into problems with inflationary pressures picking up.
Torsten, you've been making the argument that unemployment will climb. You're expecting it to rise in the months to come. What convinces you of that at the moment?
Well, the problem also with this story, with the data today, is that the AI story is just not playing out. So that means that we're not seeing people losing their jobs and the unemployment rate going up because of that factor. The expectation from our side was that there was a slowdown in demand that pushes the unemployment rate higher. But the fact that not even the AI story is showing up here, and it really is mainly a story of just a simple decline in labor force participation because we simply have a smaller labor force. And also the added issue here, government employment going forward. If we're now also going to hire more workers for ICE, if we're going to hire, generally speaking, at a number of different fronts with a huge budget increase, we could also now begin to spend much more time over the coming months on thinking about what's going on in the private sector employment numbers relative to the government sector.
You changing your mind then? Because you've been talking about stagflation for a while later this year.
Well,
there a big challenge to that right now?
So on the inflation side, I mean, Jay Powell in Sintra just a few days ago said again that he expects a meaningful increase in inflation. He said that at the congressional hearings. He said that also at the press conference. So we still have, if the Fed chair says, I expect a meaningful increase in inflation, that's something we should take very seriously. So to what Jeff's point was exactly that I still think that we're waiting to see what was the corporate response in the second quarter to tariffs. And tariffs, yes, it may seem like it's behind us. Uncertainty certainly looks better. We can begin to talk about now with this report what that means for July the 9th and the deadline next week. Yep. But the conclusion is, if we at least at the moment still have a question mark around how did companies actually respond to tariffs, I think it's too early to take the champagne bottle out here and say this is all over.
Torsten, Slok, Stephanie Roth, to the two of you, thank you. Don't pop the champagne just yet. When are we? I think we're about 12 days away from numbers from JPMorgan when we start to hear from corporate America about what the plans are for the next several quarters and beyond.
Yeah, July 15th, you start to kick off those bank earnings, and then you see whether it's profit margins or whether they're going to just pass it along to consumers, less in the banking sector and more in others. I'm sitting here thinking, how do you price in or how do you factor in slow-moving changes that are seismic in monthly data? And I think this is the reason why everyone's heads just kind of spinning, because you have all these stories that make perfect sense and these theories, but the numbers aren't really catching up.
So what do? You get to the beach. If you're not already left, all right? I think a lot of people have already left, haven't they? If you're still with us, thank you. Take us into the car with you. Nice journey with Bloomberg TV in the background. Let's give you an update on stories elsewhere this morning with your Bloomberg brief. Here's Danny Berger. Hey, Danny.
Hey, John, just a quick recap of that data. The U.S. added 147,000 jobs in June. That was higher than expected. May payrolls were also revised higher. The unemployment rate, that came in lower than expected. But labor force participation is down, and average hourly earnings fell just slightly. The report prompted traders to scrap wagers on a Fed rate cut later this month. Elsewhere, President Donald Trump and Ukraine's Volodymyr Zelensky are expected to hold a phone call on Friday. The FT reporting that the world leaders will discuss the U.S.'s decision to pause some key weapons deliveries to Kyiv. The Ukrainian president will reportedly raise the idea of a potential future arms sale. DeepSeek is ramping up hiring. The Chinese AI startup posted 10 positions on LinkedIn, signaling that it's looking for talent outside of its home market. Similar jobs were posted earlier this year on Chinese recruitment sites. The positions are based in Beijing and Hangzhou. And that's your brief, John.
Danny, thank you. Appreciate it. Have a nice long weekend. Up next on the program, setting you up for the day ahead. Plus, Bloomberg's Tyler Kendall tracking the latest in the House. House Minority Speaker Hakeem Jeffries is still speaking as we wait for that final vote on the one big, beautiful bill. Just about holding on to gains here in the equity market following that decent, solid upside surprise on the headline number, at least, in the payrolls report, and on unemployment, the right kind of downside surprise. Equities positive by 0.2%. Your trading diary for the next 24 hours, a sneak peek of next week. The House expected to vote on the president's tax bill any moment now. Sprinkler data at 10 a.m. Friday, of course, markets close. Looking ahead to next week, the president's tariff deadline, tracking everything down in Washington. Bloomberg's Tyler Kendall. Hey, Tyler.
Yeah, hey, John. Well, we're still waiting for Hakeem Jeffries to finish speaking. His magic minute is now verging on to 4 hours. I'll also point out we're just minutes away from the House being fully in session for 24 hours. And what he's doing right now is he's previewing Democrats' argument against the one big beautiful bill as it does appear poised to pass. We do have some new reporting for you. Steve Scalise telling Bloomberg News on the Hill just minutes ago that ultimately what helped to get the logjam clear, get these holdout Republicans on board as we expect them to be, was President Trump telling them that he's done negotiating and that they have to get on board to pass his agenda.
Tyler, we'll be tracking this for you throughout today, hopefully for not much longer. Tyler Kendall there of Bloomberg, thank you. We were talking about it briefly. The president emboldened. This is about to pass, we assume. Decent jobs numbers this morning. On to next week. It's going to push a little bit harder on tariffs.
At a certain point, we're not seeing the effect of tariffs come in unemployment or in inflation. You have to wonder what that does to his agenda.
You ready for the long weekend? I think we're all ready for the long weekend.
You don't even have to ask. Come on.
From New York City, thank you for choosing Bloomberg TV. Have a wonderful long weekend. Enjoy the July 4th holiday. We'll see you next Monday. From New York, this was Bloomberg Surveillance.